Hello and welcome to Session 15 of the Basic Tax course. We're going to begin Session 15 with a review of the Session 14 homework answer key. And if you recall, Session 14 was a discussion of the basis of assets. In other words, how do we arrive at the cost basis that an individual or business has in a particular asset? Now, we also spent some time defining or identifying when an asset is considered to be a capital asset and when it is not a capital asset. The importance of identifying an asset as either capital or non-capital is because we need to be able to determine what form that sale will be reported on if the asset is disposed of. So for example, if I purchase my home and then I sell my home, and I sell my home for a profit that is taxable, what form do I use to report the sale of my home on? Well, the answer is it's going to be Schedule D because my home is a capital asset, so that's the form I use to report the sale. Conversely, if I sell an asset that was used in a trade or business, a depreciable asset that was used in a trade or business, the sale of that asset is reported on a different form called Form 4797. There's more reasons than just that as to why we need to be able to identify an asset as capital or non-capital. But for purposes of today's assignment, your job simply is to understand the difference between a capital asset and a non-capital asset, and we did that with homework assignment number A. So for homework assignment number A, it says for each asset listed, define whether or not that asset is a capital asset or a non-capital asset. And I think I already gave you the first one, home. Your home is, yes, a capital asset. Number 2, your 100% business use car, is that a capital asset? Well, the IRS says that an asset that is used in a trade or business and is subject to depreciation or amortization is not a capital asset, and therefore number 2 is no, not a capital asset. Number 3, your Star Wars collection. Now, a Star Wars collection may seem like a bunch of toys, but believe it or not, your personal property is a capital asset, and so number 3 is yes, a capital asset. Number 4, land used for farming. Well, land is not depreciable. It's used in a trade or business, but it is non-depreciable. So to determine the answer to the question as to whether or not real estate used in a trade or business or in a farming business is a capital asset, I take you in the student manual to page 2 where we have a list of capital assets. The tax code says that all assets are capital assets except when they're not, and the following are situations when they're not capital assets. And you'll see right down here, real property used in a trade or business is not a capital asset. Question number 5, goodwill of a business, is that a capital asset? Well, it happens to be that intangible assets used in a trade or a business are considered to be capital assets. So number 5 is a capital asset. Number 6, franchise fee, is that a capital asset? Again, franchise fees are a form of intangible property. Even though it's used in a trade or business, it's intangible and therefore it is a capital asset. Number 7, a vacation home, is that a capital asset? Yes, it is. Personal jewelry, yes, that also is a capital asset. Feeder cattle, are they a capital asset? Well, feeder cattle are actually a form of inventory per se. They're livestock being raised for sale. So feeder cattle are definitely not a capital asset. And a milk cow? Well, a milk cow, presuming that it's used in a farming business or a dairy business, would be not a capital asset. But if this was your pet cow, it would be a capital asset. We're not really definitive on this, but the most common reason someone would have a milk cow would be as a part of their dairy business, and therefore we have allocated the milk cow as a non-capital asset. And finally, inventory or stock in trade, again, an asset that is held for sale to customers is not a capital asset. Moving on to the next assignment for Part A, problem number 2, we have some multiple choice questions. And your job is to pick the correct answer. Let's begin with the first item in line. Question number 12, John Zeller is an employee of First Tech Corp. Inc., and during the year he exercised his right to buy 200 shares of NQO stock options in Tech Corp. for $48 per share. The stock had a fair market value of $82 per share, and assuming John's annual salary is $80,000 per year, calculate the total amount of income Tech Corp should report as wages on John's W-2. And I have the answer key over here on the right lower side of your computer screen. You can see that we're going to calculate John Zeller's W-2 wages as follows. Firstly, we take the fair market value of the First Tech Corp stock on the exercise date, and that was $82. We then subtract out the exercise price that was paid, and that equals the difference that needs to be allocated or added to his wage income for the year. We're going to take $34 per share multiplied by the 200 shares to get $6,800. That is added to his salary, so for that year, John should look for $86,800 as reportable wages in box 1 of his W-2. Now, since his regular salary is $80,000, he is going to see an increase in his W-2 that will be reporting $86,800 rather than just the $80,000. John Zeller's cost basis in First Tech Corp stock is the total of the exercise price that he paid for the shares, which is $48, plus the amount that was added to his income as W-2 wages. Assuming that he buys and sells the stock in a simultaneous transaction, and most people do, the gain from the sale of the stock is going to be included in his wages. Therefore, when he reports the sale on Schedule D, he's going to have a cost and a sales price that are virtually the same. So this might be relatively straightforward and easy for you to understand as a student, or you might go, this blows me away, I don't get it at all. What's important is that when you're determining cost basis in property, you're looking at how much after-tax dollar was paid for that property. That's a simple rule to remember whenever you're dealing with cost basis in stock options, is that the employee very often thinks they paid a certain dollar amount, but they're not able to move over to the part that says, yes, but I also had wage income reported as a result of that transaction, so my cost is what I paid plus the extra amount included in my wage income. And the next problem in line involves a character named Mary. She inherited 2,500 shares of AT&T stock from her mother, Martha. Martha died on April 1st, 2011, and Martha purchased the AT&T stock back on July 3rd, 1985, at a cost of $6.97 per share. Martha did not reinvest any dividend income she received from AT&T, and a visit to AT&T's website at the URL you see in the manual here reveals the following historical data on the AT&T stock. So we essentially went into the AT&T site and typed in information to get us the information that AT&T has on stock splits that would have affected Mary's basis. You can see that there was a 3-for-1 split in 1987, there was a 2-for-1 split in 1993, and another 2-for-1 split in 1998. That means for each share that Mary had, the first split will take 1 share to 3 shares, the second split takes 3 shares to 6 shares, and the third split takes 6 shares to 12 shares. So for each 1 share Mary started with, she now has 12 shares. And her cost basis per share is going to be based, however, on the fair market value on the date of death of her mother, because they are inherited. Well, Martha died back on April 1st, 2011. So all of those historic stock splits are not relevant to the cost basis for Mary, because she's going to go to the fair market value on the date of death. So we've given you some interesting information here, except it's not perhaps relevant if Mary is inheriting it. Now, if she had been receiving the stock as a gift, it would be very relevant. Now, we look at the next chart, and this is showing that the fair market value of the stock on the date it was originally acquired by Mary's mother, Martha. So on July 3rd, 1986, AT&T had a high price of $6.97 per share, a low price of $6.93 per share. Again, that's relevant if we're looking at gift basis, but we're not. What we are interested in is the fair market value on the date of death, because that's the information we've been given, is the date of death. So the date of death is April 1st, 2011, and on that day we had a high of $30.93, a low of $30.36. So what we're going to do is we're going to take those two costs and average them out to get the basis for inherited stock. Now, AT&T does have a basis worksheet, and you can see we've entered information here as the cost basis on the original date that Martha purchased. It's provided us information on the splits so that we finally get down to a point where the split cost basis is $56 per share. And that makes total sense. If we started with 1 share and end with 12 shares, you simply take this original cost basis, divide it by 12, and that's where the 58 cents per share comes from. Now there's 2 questions in this problem. The first one is, assuming that the shares are inherited, what is Mary's cost basis? Well, her cost basis is going to be the fair market value on the date of the exercise multiplied by the number of shares that she's inherited, which is 2,500 shares. So we go down and we take 30.93, we add in 30.36, divide that by 2, and then multiply the total by 2,500. When we do that, what is our answer? We take $30.93, we add $30.36. The average of the high and the low is $30.65. We then multiply $30.65 by the number of shares inherited, and that gives us a cost basis of $76,625. So, question number 13, the correct answer is D. Password number 1 is Voyager, V-O-Y-A-G-E-R, Voyager. Moving on with question number 14. Without regard to any gift tax adjustments, what would Mary's basis in the AT&T stock be if she had received that stock as a gift from Martha rather than as an inheritance? Now, if Martha gave Mary 2,500 shares of her AT&T stock, the cost to Mary is going to be the same as the cost basis to Martha. So essentially, we're going to have to go way back to when Martha first purchased her stock. She first purchased it back in 1995 at $6.97 per share. We're going to divide that by all of the splits till we get to 58 cents per share. Based on these split allocations or these split calculations, Martha's adjusted basis in the stock is 58 cents per share. We're going to multiply that out by the number of shares held, which is 2,500 shares, and that gives us a cost basis in the stock of $1,450, and that is number 14. The correct answer is A. And for 15, for investment purposes, Alan purchased a vacant lot in 2007 for $80,000. Alan made the election to capitalize his interest and taxes and has not deducted property taxes or mortgage interest that he paid on the property. His property taxes were $400 in 2007, $600 in 2008, $700 in 2009, $750 in 2010, and $850 in 2011. He has paid $10,480 of interest on the loan he took out to acquire the property, and he also paid a lawyer $700 to defend his rights to the property. Now, because the economy has taken a turn for the worst, Alan's property only has a fair market value of $75,000. What is his adjusted basis? Well, the fair market value of the property on any particular date does not affect his basis unless he donates it or gives it to a friend or a relative, say. So if he were to give the property away, then the property would have a basis that is the lesser of his cost or his adjusted basis or the fair market value. But he hasn't given it away. It's his property. So he's just going to go with what his cost is. His cost is what he paid for it, plus or minus any adjustment items. The adjustment items are all increases, and they include the taxes he paid, the interest he paid, and the lawyer fees he paid to defend the title. So we add all of those up, and we get his cost basis. And here we have $80,000 purchase price. The cumulative property taxes he paid over the last several years is $3,300. He has mortgage interest paid of $10,480 and legal fees of $700. That leaves him with a total cost basis in the land of $94,480. That means that for 15, D is the correct answer. And moving on to homework B, we are not going to need to fill out any forms as a part of this assignment. Again, it's more multiple choice type questions. And the first question is, Angela has an IRA, and she made the following contributions to her IRA. We show the year, the amount that she contributed, and how much she took as a deduction on her tax return. Now, if you contribute money to an IRA, that contribution is your cost. The amount you put in becomes your cost. If you turn around and claim a deduction on 1040, then your cost in your IRA is reduced by the amount of deduction that you claim. So if she invests 3 and gets no deduction, then we know her cost is 3. Next, in 2010, she invests 2, but she's able to deduct 2. That means her cost is still 3. In 2009, she invests $1,500 and she's able to deduct $500. That means her cost is going to be $4,000 now. And finally, in 2008, she contributes $1,000, she deducts $1,000, and so that does not increase her cost. So what is the correct answer? The correct answer is B, $4,000. The fair market value on any particular date does not affect her basis. What affects her basis is the amount of money she put in, offset by any deduction that she claimed. So here we have a table of each year, the amount contributed, the amount deducted, and the total amount to add to basis. And you can see that we have the $3,000, the $1,000, and the total cost is $4,000. As you recall, earlier on in this course, we were looking at how to complete Form 8606 to determine our basis when we make contributions to an IRA. So in any year where Angela makes a non-deductible contribution to her IRA, she would need to complete Form 8606. Number 2, Sally Summers purchased 80 shares of XYZ stock on April 15, 2010 for $500. Then on 9/6 of 10, there was a 2-for-1 split, and on 9/9 of 11, there was a 4-for-1 split. Sally has not sold any shares of XYZ stock, and assuming that there were no other purchases or sales, how many shares does she own? And the correct answer is 640 shares. So here's what we have to say. Sally originally purchased 80 shares of XYZ stock. However, stock splits mean she now owns more shares than she actually originally purchased, and that her cost basis in each share is going to be less than the cost per share she originally paid. We calculate the number of shares she owns as follows. We go with the date bought, and the number of shares bought, and the cost per share. And then we have a 2-for-1 split on 9/6. We also have a number of shares that has increased from 80 to 160 because that's a duplication, or we've multiplied by 2. And then on 9/9 of 11, we have a 2-for-1 split. So the number of shares has gone from 160 to 640. And the cost basis has dropped accordingly each time. 625 divided by 2 is 313. 313 divided by 4 is 78. But the total cost basis in the shares she holds never changes over time. So how many shares of XYZ stock did Sally own at the end of 2011? The answer is 640 shares. Number 3, using the same information provided in question 2, what was Sally's per share cost in her XYZ stock? Well, we've already just shown you that the cost per share is 78 cents. That means the correct answer to 3 is D, 78 cents. In 2008, Jan bought 50 shares of ABC stock for $1,500. In 2009, she earned and reinvested $150 in dividends, which were used to purchase 3 more shares. Her reinvested dividends for 2010 were $200, and that purchased 5 more shares. Her 2011 dividends were $300, and that was used to purchase 4 more shares. Then on 10/5 of 11, Jan bought 20 more shares for $1,200. There was a 2-for-1 split on 10/11 of 11, and she has not sold any of her shares. How much stock does she own? So how many shares? Well, we simply do the math again. We go year by year, and in the first year, she has a cost of $1,500. It bought her 50 shares, and then the average cost per share is $30. 2009, she reinvests $150. It buys her 3 shares. The total shares has gone up to 53. The cost in her shares is now $1,650. 2010, she reinvests $200. It buys her 5 shares, meaning the cumulative number of shares she now owns or holds is 58 shares, and the total investment into her stock is $1,850. We, in 2011, have another $300 of reinvested dividends that buys her 4 shares. Her number of shares owned has gone up to 62. The total cost in her shares is now $2,150. And finally, on 10/5 of 11, she purchases 20 more shares for $1,200. The total number of shares is now 82, and the total cost in the shares that she has is $3,350. And we simply take $3,350, divide that by 82 to get her average cost per share. Now, there was a 2-for-1 split after she made her last purchase of stock, and that doubles the number of shares she owns. So if she starts with 82 shares, she's now going to have 164 shares. And if her average cost basis was $4.85 per share, we're going to divide that by 2 to get $20.43 as an average cost per share. So how many shares of ABC stock did Jan own on the last day of the year? Well, that's 164 shares. And assuming the same information is in question number 4, what is their average cost basis per share? Well, that is going to be $20.43 per share. Part 2 of homework assignment B is to figure the cost basis for a taxpayer named Janice Owens in her duplex. She lives in one half of the duplex and rents out the other, and Janice received the duplex as a gift from her mother. Her mother bought the duplex in 1988 for $58,000. The land was valued at $10,000, and in 1996, Janice's mother spent $10,000 on upgrades to wiring and plumbing. The duplex was converted to rental use in 2007 when Janice's mother gave it to her. No gift tax was paid at the time of the transfer. The duplex had a fair market value of $150,000 in 2007, and over the past 3 years, Janice has made the following improvements to the duplex. So each of these items in turn, we have to look at these and decide whether or not that is something that will add to the cost basis or whether it's something that does not add to the cost basis. And then if it adds to the cost basis, does it add to the business side of the duplex, the personal side of the duplex, or is it split between them somehow? So firstly, we have a newly installed roof that went over the entire duplex costing $6,500. We're going to add that to basis, and it's going to be split equally between the two halves of the duplex. We installed a new fence around the entire duplex. Again, that is an improvement to the property. It does add to basis, so each side of the duplex, the business and the personal, will receive half of $1,500. We recarpeted the entire duplex at $2,500, and again, that does add to the basis equally on both halves. New windows for the entire duplex, $8,000. That adds equally to the basis on both halves. Repair the sidewalk. Well, repairs are not an improvement. They do not add to basis, so we throw out the sidewalk and claim nothing for that. Now, if the sidewalk repair is indeed a repair and it's equally allocable to both halves of the duplex, Janice would be able to claim a business deduction on her rental for half the cost of repairing the sidewalk. Yard cleanup after storm in 2007, $900. Yard cleanup would be a maintenance cost. Maintenance is not going to be deductible for Janice on her side, but the rental side, she would be able to deduct half the cleanup. But in no case does $900 add to the basis. Repairs to the furnace, the 10.5 only. Again, repairs or maintenance do not add to cost basis. The $1,200 would be deductible on the business portion, though. And then interior decorating that was done only on Janice's half of the duplex. Well, we're going to assume that this is a home improvement type home decorating, that we're doing window treatments or other things that really do add to the value of the home. And as such, if there is any kind of basis improvement, it will be for Janice's half and nothing for the duplex. Janice has claimed a total of $2,378 of depreciation since 2007 on the rental portion of her property, and she also received an insurance claim of $1,500 for damage caused by vandals to the rental portion of the property. She then spent $2,000 repairing the damage. Well, there's some important information in here with regards to the damage to this business property and whether or not we have a casualty loss or a theft loss and how to go about claiming it. So we're going to talk about that. We're also going to look at the total cost of the duplex. Since the duplex was received as a gift from her mother and it was purchased in 1988 for $58,000, we're going to start with $58,000 as the cost basis in the duplex. We're then going to add the appropriate numbers here that increase basis. We've got a table in the answer key that does a good job of explaining all of this, so that's where we'll go. The question is, what is Janice's adjusted tax basis in the personal use portion of her duplex? And we've come up with an answer that is $45,750. Since Janice received this property as a gift from her mother's adjusted basis in the property becomes the starting point to Janice. To properly calculate Janice's adjusted basis in the rental property, we need to separate each of the investment items that I've just described to you. I have a table here that shows how we divided those numbers up. We have the purchase price, $58,000. And how much is going to be allocated to each half of the duplex. $29,000 is being allocated to the home, and the other $29,000 is being allocated to the rental. We then have plumbing, and that was equally split, so $5,000 and $5,000. We have a new roof at a cost of $6,500, and again, we're equally splitting that $3,250, $3,250. We then move on to the fence, $1,500, and again, we have split that equally between both halves. We next have recarpeting, $2,500, and that also was divided equally between both halves. We have the new windows divided equally between both halves. Now things get a little bit more interesting. We have repairs to the sidewalk. Again, those do not add to cost basis, therefore they're not reported in either column. The same goes for the yard cleanup and the furnace repairs. And then we have the interior decorating, which we added only to the personal portion of the property. And then we have depreciation. Depreciation is a reduction to basis, but it is only claimed on the business use portion of the duplex, so we're going to put that in the rental portion as a negative number. And finally, we have this vandal loss, and the vandal loss is deductible. So I wanted to talk to you about that vandal loss in just a minute. But let's just, for this first question, question number 6, add up the total home basis. And when we add up all of the allocations I've made to the home basis column for Janice, you will see that we arrive at a total of $45,750, which is why B is the correct answer. Let's go on again now and look at question number 7, and it says, what is Janice's adjusted basis in the rental portion of her duplex? Well, to figure that out, we need to look at this very last line here where I have net vandal loss. And what did we do to calculate that? Well, Janice had $2,000 of vandalism damage that was repaired on her property. And it happens to be the case that when you are repairing damage to a business use asset that is caused by a casualty or theft loss, the IRS will accept the cost of repairs, the reasonable cost of repairs that restore it to its original condition, as proof of the loss in fair market value. So we look at the loss in fair market value, $2,000, and subtract from that the insurance reimbursement, and that gives us the net loss, which is $500. That $500 is going to be a deductible amount to Janice on her tax return, and in the answer key I explain how that's done. But just save it for now that we're going to be able to take that $500 loss and deduct it on Janice's return. The fact that she's able to deduct it means it reduces her basis, and therefore the correct answer is $40,372. That is question 7, and the correct answer is B, $40,372. But let's return to the answer key and look at the explanation I have in here. It's a pretty complex calculation going on. It requires some definitive knowledge about what goes on with casualty and theft losses in business. And of course, when we were discussing casualty and theft losses in itemized deductions, we really didn't focus on business losses a terrible amount, but we are going to talk a little bit about it right here. IRS rules covering casualty and theft loss on business property are different than personal losses. Under the business casualty loss rules, Janice can treat the cost of repairing damaged property to its original condition as a means of determining the loss in fair market value of the rental. Since repairs were $2,000, her casualty loss is calculated at $2,000. Janice must reduce her casualty loss deduction by any insurance reimbursement received. She calculates her business casualty loss as follows. We have the cost of repairing the property to its pre-casualty condition, $2,000, minus the insurance reimbursement, $1,500, to give her her deductible loss. According to the instructions for Form 4684, casualty or theft losses, Janice will claim a $500 casualty loss on Form 1040, line 14, and she should attach Form 4797 if it is required. If the form is not required, she should write 4684 on the line next to line 14 of her Form 1040, but either way, she's deducting that $500, and because she's deducting it, it reduces her basis. So again, we return to that $500 being a reduction to her basis. The next question we're going to look at is Part 3, and in Part 3 we have a settlement statement that needs to be reviewed and a character named Jack Russell. He has purchased a fixer-upper house for $100,000, and he purchased it a couple of years ago in 2009. He purchased the house as an investment, and then on 1/1 of 2011, the house was listed for sale with a real estate agent for $210,000. Jack incurred the following expenses in the months leading up to the purchase of his house. He had travel expenses and auto expenses totaling $3,000. After purchasing the house, Jack got busy, and he made the following fix-ups. He put on a new roof, new appliances, painting and rewiring, and these are the costs associated with that. Jack also incurred the following expenses relating to the house. And you can see we've got mortgage interest that he paid, property taxes that he paid, and utility charges. The closing papers relating to the purchase are included. Let's take a look. And here is the HUD settlement statement for Jack Russell. And we can see that we've got the contract price for the purchase of the property, the agreed upon sales price when he purchased it. We then have settlement charges totaling $64.77. And the instinct is to say, hey, I'm going to add that to basis. But it doesn't quite work that simply. We're going to have to look at the breakdown of that $6,477 to see where it came from. Some of it probably does add to basis, but there's other amounts that probably don't add to basis. We also have this county taxes here of 7/1/2009 through 10/5/2009, totaling $398.63. That is going to be a proration for the period of time that he owned the home. But what's interesting is that he purchased the home back on 10/5/2009, and this proration is for a period of time before that. So what this means is that the buyer is giving this money to Jack so that Jack can pay taxes owed on the property for a period of time when Jack did not own it. And therefore, this money is not income to Jack, nor is it an expense to Jack. It simply does not affect his basis at all. We have a deposit that is going to be applied towards the sales price, so we're not going to add the deposit to the contract price. And then he has a new loan that he took out for $90,000. And that is the first page of the settlement statement. Moving on to page 2, we really do end up with some numbers that start to mean something. And you will see here he has loan origination fee and loan discount fee, each of which are $900. That makes his total points $1,800. Those will add to his cost basis. He also paid an appraisal fee and for a credit report totaling $550. Down on line 901, we show that he has interest or daily interest charges of $427.44. I did want to point out that any amount that you see as a daily interest charge is going to be reportable on Form 1098. So you don't want to take this number and add it to the number already showing on 1098, nor do you want to add it to a number that we already provided you as interest paid for the year. This is really already included in that number. But the points are not going to be included in the interest paid for the year per se. Those usually are paid at close from money that is brought to the table at close. Next, we have the initial deposit into the escrow account, and that's $1,050. Well, escrow deposits are not income and they are not expenses. It's only when the money comes out of escrow and is used to pay an expense that we have a deductible expense. So you can think of an escrow account as a holding or savings account, and you don't consider money in a savings account to be an expense. You only call it an expense when you pull that money out and spend it on something. So amounts put into the escrow account do not add to basis. Next, we have the title charges, and title charges do add to cost basis. We have $2,150 of title charges. We have document prep fees and notary fees, each of which were $50 and do add to basis. We then have government recording fees of $250 and a pest inspection report of $150. So that's where the total settlement charges come from in the amount of $6,477.44. And some of that, most of that is actually going to add to basis, but there's certain numbers that we have to pull out. And the numbers that we pull out that we do not add to basis are the $1,050 right here, the daily interest right here, $427. But the rest should add to basis. Now moving over to the answer key in the bottom right-hand corner of your computer screen, there are other items that we are going to add to the basis in this property. Remember, we had travel expense and auto expense, also the cost for the new roof, the appliances, the painting, and the rewiring, and then all of the interest and tax payments and the utility payments that Jack Russell made during the period of time he was purchasing and holding that property while he got it ready for resale. We then have the settlement charges, and I just put $6,477 in there. I added in the purchase price of $100,000, and then I subtracted out the non-deductible amounts. We have an adjustment for prepaid insurance, we have an adjustment for prepaid interest, and we have adjustments for tax deposits. So the total adjusted basis is $129,994. So you can see here we have $427. We've pulled that number out. We then have the homeowner's insurance of $300 that we pulled out, and we have the property taxes of $750 that we pulled out. So again, these are the numbers that I said would not add to basis. We've subtracted them out here, and that gives, again, total adjusted basis to Jack Russell of $129,994. And that makes C the correct answer. So that concludes the review of the Session 14 homework assignment. It is now time to push pause on video playback and take the Session 14 quiz. When you are finished, please resume video playback for the Session 15 lecture, and the Session 15 lecture is Depreciation. I hope you enjoy it. I want to welcome you to Depreciation because guess what? It is my favorite topic. I love depreciation. Now, one of the reasons I love depreciation so much is that it's actually not something that comes naturally to me. In the world, we know we have a right side of our brain and we have a left side of our brain. And people who are left-brained tend to be good with numbers and math, and people who are right-brained are more artistic, right? We kind of knew that, right? And so anything to do with numbers would be a left-brain thing, and I'm not terribly left-brained. I'm more center. So when I get to numbers, my heart starts pounding, and I get worried that I'm not going to be able to grasp it. And so the first time I saw depreciation as the subject of the day when I was a beginner tax school student, I went into a mental lock. I knew I couldn't get it, that it would be too difficult. When I thought ahead to the state exam I was going to have to pass, depreciation had me in a total panic. And one of the things that had me in a total panic were the maker's depreciation tables, because I was convinced for some reason that I was going to have to memorize all the numbers on these tables in order to pass the test. And I said, that's impossible. I can't memorize those tables. What I need to do is understand how the tables came to be, how those numbers are on the tables, why they're on those tables, and then I can just manually calculate any number I'll ever need. And so that's what I did. Back in 1993, when I was a brand new student, didn't know anything much about tax law, I came to depreciation and I spent however much time it took me, can't remember how much time that was, figuring out how the tables work and why. And so ever since then, depreciation has been something that I understand, and my goal today will be to help you learn to understand depreciation the way I do, so that something that can be quite terrifying is actually not that scary at all. Now, having explained how the right brain has a harder time with this than the left brain, I know that I work with all kinds of people on my staff who I would consider to be very left-brained, who still struggle with depreciation and don't understand it. So even though they understand how to use numbers well, depreciation still stumps them. And I would say the reason for that is, although there are parts of depreciation that are very practical, this is how the numbers work, this is how the formula works, there's also all the factual knowledge that you have to have about all the different systems and all the rules that apply to those systems. So it is a left-brained and a right-brained type of content or topic, because left-brained is what you need to be to get the math side, and right-brained is what you need to be to get all the factual side. So somewhere we're going to get you in the middle. Understanding all of it is my hope. So we're about to cover, as I said, what is my favorite topic. And I call it Depreciation Made Easy because for me, depreciation is easy. And I hope to make it easy for you by the end of today. Now, no depreciation course would be complete without the Bible of Depreciation, and that is publication 946. If you have yet to read this publication in its entirety, I can assure you, you have missed a gripping read. Okay? Everything you ever wanted to know about depreciation, fairly much, is in here. If you've read it and it has big type, you'll understand most of what you need to know. If you've never read the book, that might be why you're confused. But I'm going to take you through what I consider to be the high points of the book. I'm also going to take you through some of the instructions for Form 4562. The instructions for Form 4562 are also lengthy, and interestingly, they are a complement to 946, but very often do not repeat 946. So some of the information contained in 946 is not in the instructions for 4562 and vice versa. In addition, this publication is called, 946 is called How to Depreciate Property. And well, you depreciate tangible assets, but you amortize intangible assets. And this says how to depreciate property. It doesn't say how to depreciate or amortize property. And that's because amortization just really isn't covered in here. So if you want to learn about amortization, oddly enough, you have to go to publication 535, which is a business expense publication. It confuses me why they didn't put it in the depreciation publication, but, well, that's our government. And then there's also some recommended reading from publication 463 as well. So if you really want to get a handle on everything in today's class and how I put my book together and how I gathered my topics together, these are really the sources that I used. So let's move on then to the introduction. And of course, the whole point of depreciation is that when you purchase an asset for your business, the government says that the purchase of that asset is not really an expense. It's more like an investment, because you've purchased an asset, say for example like a computer, and you've paid $1,500 for a very nice computer. You want to call it an expense because you did take that $1,500 out of your bank account or out of your pocket and pay for it, but you still have the computer, and you could turn around and sell it and get money for it. So it's really not an expense per se in the way we think of expenses. Like you pay for a meal out, that's an expense. The food's done, it's gone, you've got nothing left to show for it except a full tummy at the time, and a few hours later that hardly matters. So you compare that kind of expense to the kind of expense of investing in an asset, and that's why there is a difference. The asset has value over time, it's here over time, and the IRS wants you to account for that when you do tax returns. So the question is, who has to depreciate property? When do you have to depreciate property? And how do you depreciate property? And the first rule is that you don't get to expense property. There are provisions in the IRS regulations for doing something called a Section 179 expense deduction, but you're still really depreciating the property. And so we're going to cover that as well. So if you use property for your business, you cannot treat the cost of that property as an expense, and instead you must recover the cost of that property each year based on the asset's expected useful life. The system of claiming cost of property over its expected useful life is called depreciation, and in some cases amortization, depending on the type of property we're talking about. The expected useful life of depreciable assets is shown in the Appendix B of IRS Publication 946. If you printed out a copy of the student manual before today's class, I have a copy of Appendix B at the end of the student manual. And so I have a printout here of the student manual, for example, and you can see the very last page of it is part of Appendix B. And Appendix B occupies a good, 8-10 pages at the end of the manual. So you already have a copy of it there. If you already have a copy of Publication 946 handy, you also have the appendix in there already. And incidentally, IRS will send you this publication at no charge. U.S. government publications are free, and all you have to do is order them, and it takes about 10 days for it to arrive in your mailbox from Uncle Sam. And if you want 2 copies, just send them to 2 addresses. They will send you 2, or come up with 2 people at the same address, and they'll send 2 copies to the same address, because after all, we can't get enough of this baby. As many copies as you can possibly hold on to, because I need them at home, I want them at work, I want them everywhere. Oh, and if you don't have a printout, you can always go to irs.gov and read it on their website. Then you don't have to print it at all. All right, but the amortizable life of intangible assets is described in IRS Publication 535. One chapter in there is devoted to that. So let's move on now to a discussion of the types of property, because the IRS classes property or classifies property as being either tangible or intangible, and the nature of property being tangible or intangible generally tells you whether it's depreciable or amortizable. Now, tangible property is property that you can see and touch. It includes things like land and buildings, but also cars, television, clothes, etc. Even the family dog is a piece of tangible property. You can see that dog, you can touch that dog, you can pet that dog. Now, if you're a greyhound racer, you could even depreciate that dog, assuming you were in it for a business purpose, right? There are 2 types of tangible property. Tangible property is essentially divided into real property and personal property. And of course, real property includes land, buildings, and generally anything built on land, growing on land, or attached to the land. Personal property includes cars, trucks, machinery, furniture, that family pet, milk cows, and anything else you can pretty much see and touch that is not built on land, attached to the land, or growing on the land. Intangible property is property that has value but cannot be seen or touched. And examples include patents, copyrights, and goodwill. Also, the going concern value of a business, such as the workforce in place. Now, there are some tangible assets out there, or pardon me, intangible assets out there that have extremely high value, and well, you can sort of see and touch them, but they're still intangible, and that would be something like the Coca-Cola logo. Do you think that's worth a lot of money? Yeah, Coca-Cola's logo is worth a ton of money, and so is the Nike swoosh. And so logos are worth a lot of money. Branding, the brand name recognition is worth a lot of money. And there are people who are actually able to put values on those. And when they do put a value on them, they're putting a value on an asset that is intangible. Mickey Mouse, that would be another intangible asset, I would think, worth a lot of money. So what is the difference between depreciation and amortization? Well, generally, you depreciate tangible property and amortize intangible property. We'll do a little brief definition here of depreciation. Depreciation allows you to claim a deduction for the loss in value of an item because of wear and tear, age, or other cause. Under the Internal Revenue Code, there are a number of different depreciation recovery methods that allow you to claim a deduction for the loss in value of an asset. Depreciation is used on tangible property. However, prior to August 11, 1993, you could amortize or depreciate intangible property. And it's interesting, 1993 was essentially the year I got into this business. My very first tax season ran January of 1993, and I can remember that I was actually working with depreciation on an intangible asset that fell into that window of time. There was a very narrow window in time there where they were changing the rules for how to depreciate or amortize intangible property, such as goodwill and franchise fees and things of that sort. But ever since then, things have been pretty stable. Amortization allows you to claim a deduction for the cost of an item over its projected useful life, and since August 11, 1993, the law requires the cost of intangible property to be amortized rather than depreciated. Amortization is always straight line. The allowed recovery period for most intangible property is spelled out in the IRS regulations. And in general, most intangible property is depreciated or amortized over a 15-year period, straight line. However, prior to October 23, 2004, certain costs, including business startup costs, could be amortized over 60 months. So 2004 is recent enough that there's probably a number of people out there who still think of business startup costs as something that get amortized over a 5-year period or 60 months. But it was in 2004 that that rule changed, and it changed to be 15 years. That's a significant change, going from 5 to 15 years. They tried to compensate for that somewhat by introducing a paltry little deduction for startup costs that you get to claim that helps small businesses out. But anyone who's invested a good deal of money in startup now has to amortize over 15 years. So let's take a closer look at depreciation. And most of today's class is going to be focusing on depreciation. As we get towards the end, one of the final topics will be amortization. And the reason I'm teaching it that way is, well, I like to teach tax law in the order of the tax form. And we're going to be looking at Form 4562 today. I do have a copy of the form in your manual. If you haven't already printed a copy of it, and I'm mentioning a particular line on the form, you can always flip in the manual if you have that. And I have Form 4562 appearing on page 53 and 54 of the manual. So I'm just jumping ahead here to show it to you. So I'm inside the student manual, and this is page 53 where I have Form 4562. And as much as I can, I'm going to be taking this form somewhat in its order, although not entirely. For example, I'm not going to talk about the Section 179 deduction until a little bit later in class, even though that is part 1 of the form. I've tried to put things together in a manner that flows, and sometimes that's in the order of this particular form, and sometimes it's a little bit out of order. But amortization for sure is the last thing on this form, and it is the last thing we're going to cover in today's class. I almost laughed at amortization because when you look at Form 4562, amortization in Part 6 seems to be almost an afterthought. They threw it on at the end because it had something to do or was similar to depreciation, they figured. But amortization has enough separate individual rules of its own. Quite frankly, I could see it having its very own form. But IRS has chosen to put it on the same form as depreciation. So depreciation is the method used to recover the cost of most tangible property. You can claim depreciation for most tangible assets that are used either in your business or for rental purposes. Property used in any of the following ways is considered to be property used for business: rental property, self-employment, partnership, S corporation, farming, or employee business expense. How you depreciate property depends on the type of property you are using for your business, and some of the more common types of property used for income production in a business include land, buildings, furniture and office equipment, cars and trucks, heavy machinery such as bulldozers, tractor trailers, assembly lines, etc. If you're a farmer, you're going to be depreciating your farm animals that are used for income production, such as milk-producing cows and breeding animals. Also, you can depreciate computers and peripherals and improvements to property such as roads, bridges, landscaping, room additions, and other improvements to building. But note, however, that the following assets are never depreciable. The first one is an asset that has a useful life of 1 year or less. That means it's a supply. You buy it, it gets consumed, it runs out, so you don't depreciate it. The other is an asset that is placed into and taken out of service in the same year. So you buy yourself a computer, and before the year is out, something happens to it, it's toast. You would never bother depreciating it because it's in and out within the same year. That would be an example of, well, actually probably a real expense. And then the last one is land. Now the thing about land is, I would say this is one of the most common errors that I see taxpayers make on their own returns, but it's also one of the most common errors I see tax preparers make on returns when they're preparing depreciation schedules. And that is, when you are depreciating real estate, most real estate is attached to land. And therefore, a part of the cost of that real estate is for the land that the building is sitting on, and you need to pull the land value out and not depreciate it. And what I most often see is that the entire cost of a piece of property is being depreciated without regard to how much of that value is for the land, and that is, well, completely wrong. And how do you figure out land value? Well, there's all different kinds of ways to figure out land value. One of them would be the property tax statement. That typically shows what the land is. You can also go on the internet and research land values. Here in the city of Portland, I go to the Multnomah County. There's actually a City of Portland website where I can go look up an individual piece of property. I can see the address of the property, a land plot of the property, the crime rate for the property, the assessed value of the property, and the portion of the assessed value that is for structure and land. Now, if the City of Portland is able to offer that, it would not surprise me if most of the country has something similar. And it's just a matter of searching your local area on the internet for what it is that they have available. But at the very least, your client should be bringing into you a property tax statement that will contain all of that same information. Depreciation systems. So part of today's class is going to be learning terminology. The first piece of terminology we discussed is the difference between amortization and depreciation, and what is tangible property and what is intangible property. Now we're going to be learning some more terminology, and the first piece of terminology we're learning is depreciation systems. So the law does not allow you to claim depreciable assets as an expense. This is because depreciable property has a useful life of more than 1 year and continues to have value over time. If your business property has a useful life of more than a year, you must generally spread the cost of the property over the assigned useful life of the property. Assigned useful life determines the rate at which the cost of property can be recovered, and the following depreciation systems have been used to recover the cost of property through depreciation. The first system we're going to talk about is one that definitely predates me in the world of income tax law. It doesn't predate me when I was born. I was definitely born before then. I remember before then, but I wasn't involved in taxes before then. And we're talking about the pre-Reagan era. We're talking about Carter and back. We're talking about Kennedy and back. We're talking way back. And back in the olden days, businesses were allowed to depreciate property over its expected useful life. This meant that a business, rather than the IRS, would determine the useful life of business property and depreciate it accordingly. And as you might imagine, that meant that different businesses would apply different lives to the same kind of property. So I would imagine if an auditor came into a business, the first thing that auditor was going to have to do was figure out how they were depreciating property. So it made sense, at least to me, looking, now that we're looking back in time, that having a set system for depreciation where everyone has to follow the same rules makes sense. It simplifies it and provides order. But depreciation systems that were used prior to 1981 include useful lives, straight line, or an accelerated method of depreciation such as the declining balance method. Property placed in service before 1981 is referred to as non-recovery property. The fact that it is non-recovery property has something to do with Form 4797 and how you fill that form out. But it doesn't really have much to do with today's class other than telling you it's called non-recovery property. Now, Reagan came in and he decided, along with Congress, that we needed to have a new system of depreciation, and they named it Accelerated Cost Recovery System, or ACRS. And beginning in 1981, the government assigned a useful life to the different types of property used in business and created a standardized method for calculating depreciation called ACRS. ACRS rules apply to assets placed in service after 1980, but before 1987. So what you can guess happened is that there was this 6-year period of time where they were figuring out everything they liked and didn't like about ACRS. And when they were done with that review, they modified ACRS and called it MACRS, Modified Accelerated Cost Recovery System. So beginning in 1987, the government modified the assigned useful life of property and introduced this new system called MACRS. MACRS applies to assets placed in service after 1986, and now, since MACRS has been in use for more than 20 years, most assets currently being depreciated fall under the MACRS rules. Now, there was a period of time when I was teaching class that ACRS was still around in large part, but every analysis I've ever done of the ACRS table tells me that the longest life attached to any asset under ACRS was 20 years. So that means 2007, we should have completely depreciated everything that was being depreciable under ACRS, and therefore you're not doing ACRS calculations in modern times. Interestingly, as recently as 2002, 2003, when I was teaching my basic tax course, I would work with the IRS office here in Portland, Oregon, and call them up and say, I need, about 40 depreciation publications shipped to me. And they would ship me the ACRS publications. I didn't specify 946, so they sent me the ACRS publications, somehow imagining I would be interested in those, or maybe not understanding the differences. But the days are gone where IRS ever ships me IRS publications anymore anyway. But I remember throwing out dumpster loads of these ACRS publications. So now we're on to MACRS, and MACRS has a series of recovery periods that we're going to talk about. So the first thing we talked about was the depreciation system, right? The depreciation system we're working under today is MACRS. But if you're looking at an old asset that's been around for a long time, it could be a non-recovery asset from pre-1981. It could be an ACRS asset that was placed in service after 1980 but before 1987, and everything else that you might be depreciating is probably going to fall under MACRS. So that's the depreciation system. Now we're going to look at recovery period. And the definition of recovery period is that recovery period of property is the number of years over which you are allowed to recover the cost of your asset through depreciation. There are two recovery systems. The first one is called GDS, or General Depreciation System, and the second one is ADS, or the Alternative Depreciation System. There are significant and important differences between the two systems. Most people use the general depreciation system right here. And computer software typically will default to GDS, since the vast majority of clients fall under GDS. But there are certain clients who fall under ADS, and if you don't understand the difference between the two, and you give GDS to a client who does not qualify for it and should be under ADS, well, you've just done the return wrong, haven't you? So let's look at some of the face differences between them, and what you'll notice is recovery period and recovery or property class under GDS is pretty much matched. 3-year property under GDS has a 3-year recovery period. 5-year property is recovered over 5 years, 7 years over 7 years, and you also have 10-year property, 15-year property, 20-year property, 25-year property, 27.5-year property, and 39-year property. Under ADS, things start off sort of similar and then they change rather dramatically. 3-year property is recovered over 3 years, 5 years over 5 years, but by the time you're up to 7-year property, the recovery period under ADS is 10 years. 10-year property is 20 years, 15 is 20, 20-year property is 25-year recovery, 25-year property is 50-year recovery. Residential rental property that was 27.5 years under GDS is 40 years under ADS, and non-residential rental property is also 40 years under ADS. And then finally, ADS personal property with no class life assigned to it is depreciated over 12 years under ADS. So those are some significant differences. Obviously, if you're talking about the rate of depreciation, the number of years you depreciate something over is going to affect the size of the deduction you're allowed to claim on a year-by-year basis. So ADS will typically give a smaller deduction than GDS, but it will give the deduction for a longer period of time. There's a question in the classroom, is there any difference between new and used equipment? And there is a difference in how you are allowed to depreciate new and used equipment, but it depends on what your definition of the word used is. If you own a computer that you bought for personal purposes and you convert that to business use, that would be what I consider to be an example of used property for depreciation purposes. But if you go into a used computer store and buy a used computer, as far as depreciation is concerned, that's a new purchase, and you depreciate it as if it was new. So it depends on what you mean by used. IRS definition of used is essentially it's your used property, or a relative or a friend gave you their property or sold you their property, that type of thing. All right, so now we're going to look at a little more detail on the alternative depreciation system, who has to use it, when, and why. For most businesses, GDS is the depreciation system which must be used. It is the default system. However, ADS is required in certain situations. You are required to use ADS for the following property. Listed property used 50% or less for business. Any tax-exempt use property. Tangible property used predominantly outside of the United States. All property used predominantly in a farming business and placed in service in any year in which an election not to apply the uniform capitalization rules was made. I have a little caption in here on Internal Revenue Code section 168G1A. It provides in general that any tangible property used predominantly outside of the United States during the year shall be depreciated under the alternative depreciation system as follows. Number 1, the method must be straight line without regard to salvage value, and the recovery period is determined using the following table. Personal property will depreciate it over 12 years. Non-residential real and residential rental property will depreciate it over 40 years, and any railroad grading or tunnel bore will be depreciated over 50 years. Why that one stands out, I don't know. All I know is that's what the publication told me, so I'm telling you. When can I choose to use ADS? Even if you qualify for GDS, you can choose to use ADS. The election must generally cover all property in the same property class that you placed in service during the year. However, residential rental and non-residential rental property can be made on a property-by-property basis. Once you make the election, you can never revoke it. Now, just because you make an election to go ADS in a particular year for a particular class of assets being placed in service in that year does not mean you have to use ADS for all other asset purchases in all future years. It only means that in that year, if you chose to go ADS, in a later year you can't change your mind on the property that was already in service. You set a life for property and you stick to it. In essence, the IRS does not want you to change your mind. They want you to put pen to paper, select a system, and stick with it. The only exception to that is when you select an unallowed system, that you're depreciating in a method that is not permitted. And then they do want you to go and correct it. And how you correct it would either be through an amended return, if you catch the error quite quickly, or if the error has been going on for an extended period of time, there is a system where you can file for a change in accounting method and make up for the entire difference at one time on a single return or by carrying it forward over a few years. Question. There's a question in the classroom, all property used predominantly in farming, and what does that mean? Well, farmers are supposed to apply the uniform capitalization method, and I'm not going to talk about what that is. That would be, it's an accounting concept about how you capitalize property, and farmers are supposed to use the uniform capitalization method. If they make an election not to use that method of accounting, then they are required to depreciate property using ADS. That's what it means. So if you have a farmer who says, I don't want to use the uniform capitalization method for my accounting, then that farmer is not allowed to use GDS. That's what it means. If you have a farmer who is applying the uniform capitalization rules to accounting, then he can file GDS like any other business with property inside the United States that is not otherwise required to use ADS. So, can I choose to use ADS? The answer is yes, you can elect to use ADS. However, it's an irrevocable election for that year for that class of property. For that 1 year, for the class of property placed in service in that year. And in a future year, if you purchase new property, in each and every year you purchase and place property in service, for that year you buy that property, you make a decision about how you're going to depreciate. And what you did in an earlier year has no bearing on what you're allowed to do in the next year. When can I use GDS? Well, most assets used in a business that are not listed property used 50% for or less for business qualify for GDS. And GDS is, of course, all about makers, or makers is all about GDS, or vice versa. They kind of go hand in hand. The U.S. government has set a standardized useful life and recovery period for most assets. Appendix B of Publication 946, pages 103 through 113, shows the asset classes and their assigned useful lives. Now, this is pretty exciting stuff, people, because I have observed that there's a lot of tax preparers who seem to pull the useful life of an asset out of their hat. They don't, you're not supposed to pull it out of your hat. You're supposed to pull it from this publication. So you go to the publication, and this is pretty exciting. I'm going to go in my manual to one of the pages I'm looking at so that you can follow along with me. It's kind of one of those aha minutes in life. Really? I didn't know that? So I've flipped in the manual to page 75, and this is Table B that appears in Pub 946, and it's the same exact page that is on page 104 of 946. So let me see here. What does Table B1 have to say? It says that if you have assets in class 00.11, which includes office furniture, fixtures, and equipment, and it says that are not a structural component of a building. It includes such assets as desks, files, safes, and communication equipment. It does not include communication equipment that is included in other classes. Okay, the class life in years of this asset is 10 years. The maker's recovery period is 7 years, and under alternative depreciation, it is 10 years. So if I'm filing makers under GDS and I want to know what the life of the new desk is that my client bought, I would go to this publication and determine it is 7-year property. Let's look at the next one, 00.12. This is really exciting, folks. Information systems includes computers and their peripheral equipment used in administering normal business transactions and the maintenance of business records, their retrieval and analysis. That sounds like a computer, right? Yeah, it includes computers and peripheral equipment. Peripheral equipment consists of auxiliary machines which are designed to be placed under the control of the central processing unit. That sounds to me like, I don't know, a printer, a network copier, things of that sort. Anything that talks to your computer is probably going to be an information system. And guess where computers fall? They're 5-year property under makers. They happen to be 5-year property under ADS as well, but one of the things we did discuss is that personal property under ADS that's placed in service in a foreign country is actually 12-year property. There's a question in the classroom, do I really depreciate a $40 calculator over 5 years? Well, there's the realistic approach. Quite frankly, I probably would write a calculator off as a supply or as an expense type thing. There's nowhere in the IRS instructions where it says any asset that costs you over $100 has to be depreciated, or any asset that is $75 or less can be disregarded for depreciation purposes. There's no rule that says that. So you're left with the rule of common sense. And do you really want to have a depreciation schedule that lists 5 calculators that were probably closer to $7 each than $40 each? Probably that's not necessary. And in practicality, almost no one does it. But where do you draw the line and say that waste bin that I bought, well, that waste bin, quite frankly, would be classified as 7-year property. And I've actually had that waste bin working hard and strong in my tax office for more than 20 years, and it's still kicking strong. Could I sell that waste bin 20 years old and get money for it? I bet you I could. I could hold a garage sale, and I bet you someone would give me their 2 bits for it. Because what are they new? If you go over to Home Depot, where they sell dust bins just like that, I think they want a good 12 bucks for one. So I bet it's still worth something. But yeah, there is the common sense practicality side of it. And also, when you're a tax preparer doing tax returns, and you're preparing a depreciation schedule, it is normal and customary in our business to charge for each line on that depreciation schedule. And if you start charging $3 a line for dust bins and calculators, your client will fire you. So there's lots of just common sense that has to go into it. Now let's take a look a little bit more at this Appendix B, because, you know, or Table B, I just love it. I love looking at it. So you have to humor me as your instructor. There's something here called 00.13, data handling equipment except computers. Also, if it handles data but it's not a computer, what would that be? Typewriters, calculators, adding and accounting machines, copiers, and duplicating equipment. They too are 5 years under GDS. Just in case you were confused about whether or not a copier and a printer were the same, they're not, but they have the same life. Now, there's an importance to also understanding these classes, because remember, if we made an election under the depreciation rules to go to ADS on our computers, it would mean I'd have to make that election for all property that falls in the same class as my computer. So if it's a computer and it's a printer connecting to that printer, or a printer connecting to my computer, and I elect to go ADS on the computer, then I must also do ADS on the printer that was placed in service in the same year. But if I purchased a typewriter, I would not be forced to ADS on the typewriter because it belongs to a different class. So in effect, I could elect ADS on the computer and printer and be able to do GDS on the typewriter because they are in different classes. So when the IRS says you must maintain or make an election for one class of property and apply that election to all property placed in service in that same year in that class, how you establish whether or not 2 assets are in the same class would be by going to the asset classes in this publication. Now, if you happen to be in the business where you use airplanes, there are classes for airplanes too, including airframes and engines, except those used in commercial or contract carrying of passengers. Okay. Automobiles and taxis belong to a particular class, 00.22, and they are 5-year property under GDS as well as under ADS. But look at this, they are really actually considered to be a 3-year class life. Buses are in a different class than automobiles and taxis. Light general purpose trucks are in a different class than general heavy purpose trucks. So let's see what the difference is. A light truck weighs less than 13,000 pounds, and a heavy truck weighs 13 pounds or 13,000 pounds or more. Okay, I have someone in my classroom asking me why, when it says 3 years, do we depreciate over 5? You would need to reference the legislative discussions that occurred when these tables were created, and I have not personally read those, so I couldn't communicate that to you. There's probably somewhere in all of the discussions going on where people decided that, but I wasn't privy to those conversations. When it comes to the tax code, I rarely ask why, because there's little point. Most of the time with the tax code, all I need to know is what is the law. And the whys behind it might be an interesting anecdotal discussion, but not really relevant to our job as tax preparers. They're relevant if you want to get up there and lobby your congressman because you want to change something. All right, tractor units for use over the road is in asset class 00.26. 00.27 is trailer and trailer mounted containers. And then we have vessels and barges. Oh, here's one, land improvements. This is rather important because this would affect all kinds of businesses. Includes improvements directly to or added to land, whether such improvements are Section 1245 property or Section 1250 property, provided such improvements are depreciable Examples of these assets include sidewalks, roads, canals, waterways, drainage facilities, sewers, not including municipal sewers in Class 5-1, in case you were wondering, wharves and docks, bridges, fences, landscaping, shrubbery, or radio and television transmission towers. Does not include land improvements that are explicitly included in any other class, and buildings and structural components as defined in section blah, blah, blah. So that kind of property has a 15-year depreciable life under makers. And we go on and on. If you're into farming, you'd be interested what comes on the next page, because we get into some of the classes of assets that affect farmers. Under 01.1, we have agriculture, includes machinery and equipment, grain bins and fences, but no other land improvements that are used in the production of crops or plants, vines, etc. And those are 7-year property. Then we have 01.11, cotton ginning assets. Then we have 01.21 that includes cattle, whether they're breeding or dairy. Cattle are 5-year assets, or 5-year depreciable property under GDS and 7 years under ADS. So if your farmer is forced to go ADS, then he would go 7-year property on his cows. But look at this. When you get into horses, things are pretty specific. We have to be real careful about these horses, because horses, they're very specific. Any breeding or work horse that is 12 years old or less at the time it's placed in service is 7-year property. But any breeding or work horse that is more than 12 years old at the time it is placed in service is 3-year property. And any race horse that is more than 2 years old at the time it's placed in service is 3-year property. And any horse that is more than 12 at the time it is placed in service, and so on. So you got to be real specific about your horse when you're deciding what class it's in. Then we move on to hogs breeding. They are 3-year property. Hogs definitely live less long than horses, apparently, and definitely less long than cows. Then we have sheep and goats breeding. They belong to the same class. So interestingly, sheep and goats are considered to be similar, but horses, all different kinds of horses, are not as similar to each other as goats and sheep are. Then we have farm buildings. And farm buildings are 20-year property, but if you're depreciated under ADS, they're 25-year property. And then we have finally something called a single-purpose agricultural or horticultural structure within the meaning of Section Code 168. Can anyone give me an example of what a single-purpose agricultural structure might be? A silo? Grain silo? A barn would not be single-purpose. A milking barn, well, if you can only use it for milking, then it would be single-purpose, right? When I think of a single-purpose agricultural structure, I think of something like a chicken coop, right? It's used for one thing only, and that's housing chickens. It would still be fowl-related if we put pigeons in it, right? Let's compare that to a barn, where you would use it for storing farm equipment. You'd use it for storing hay. You might put your horses in there, your cows in there. So a barn is 20-year property. A single-purpose agricultural structure is going to be 10-year property. A horticultural structure has anything to do with the growing of plants. So I think of a horticultural structure as something like a greenhouse. And a grain silo, is that agricultural or horticultural? Because it's used for grain products, which are plant-related, but it could be agriculture. I am not a farmer, but maybe a farmer could clarify that for me. I live in the city of Portland. There ain't many farms nearby. Okay, so that's my review of the appendix for 946. Let's move back in our manual, because now that we know how to determine the recovery period of our property, we're going to be able to start talking about some more interesting stuff. And I think we left off on page 6 or 7, so I'm going to bounce back there. So yeah, we left off right here by taking a look at Appendix B. And we've taken a pretty close look at it, but let's kind of summarize the highlights of Appendix B. Appendix B has told me, and I'm telling you, that 3-year property includes things like any qualified rent-to-own property, any racehorse without regard to the age of the horse that is placed in service after December 31, 2008 and before January 1, 2014, and any horse other than a racehorse that is more than 12 years old. 5-year property includes things like automobiles, light general purpose trucks, typewriters, calculators, copiers, and duplicating equipment, any computer or peripheral equipment, and appliances, carpet, furniture, etc. used in a rental real estate activity. And of course, all of the useful lives I'm explaining to you here are maker's GDS life for property inside of the United States. 7-year property includes office furniture and equipment, any property that does not have a class life and is not otherwise classified. 10-year property includes vessels, barges, tugs, and similar water transportation equipment, any tree or vine bearing fruits or nuts, any qualified smart electric meter and qualified smart electric grid system placed in service after October 3, 2008, any general purpose agricultural or horticultural structure. 15-year property includes any qualified leasehold improvement property placed in service before January 1, 2012, any qualified restaurant property placed in service before January 1, 2012, and land improvements, fences, landscaping, shrubbery, etc. And 20-year property includes farm structures other than single-purpose agricultural or horticultural structures. 25-year property is water utility property, which is property that has an integral part of the gathering, treatment, or commercial distribution of water that without regard to its classification would be 20-year property. And municipal sewers. If you happen to do depreciation for municipalities, you want to know what the life of a sewer is, it's 25 years. But this classification does not apply to property placed in service under a binding contract in effect at all times since 1996. What was special about 1996? I think that's the year Star Trek First Contact came out. That was a good movie. Okay, 27.5-year residential rental property is a building in which 80% or more of the total rent is from dwelling units. 39-year non-residential real property is any real property that is neither residential rental property nor property with a class life of less than 27.5 years. Now, while we're on this 39-year non-residential real property, I should point out that when Clinton came into office, President Clinton, non-residential real property was depreciated over 31.5 years, and residential rental property was depreciated over 27.5 years. And one of the things that Clinton did when he first came into office as part of the legislation he had passed to reduce the deficit way back then was he increased the life of non-residential rental property from 31.5 years to 39 years. So it is entirely possible that occasionally you will run across a commercial building that is being depreciated over 31.5 years, and if it was placed in service before 1993, that would be correct. So if it was post-1986 and before 1993, there is a window of time about 6-7 years where commercial property was 31.5 years. But we've been at 39 for a very long time now, and most people in the industry today only think 39. Oh, let me see, I do have a question here. I see some of my webinar students asked me for gave me a couple questions. Rumpelstiltskin says, what about iPads? iPads would be 5-year property. Yes, they do fall under information systems. An iPad would be 5-year property. Cell phones are 7-year property because they're not classified anywhere. So actually, if you can't determine that an iPad is a computer, and you may have trouble doing that, if an iPad is a class that can't be identified, and I think of it as a computer, but it could also just be a communication device, I would say an iPad is probably 5 years, but if in doubt, 7 years, because anything that's not classified is always 7 years. Will I be clarifying the difference between 1245 and 1250 property? I can tell you, Ralph, that 1250 property is real estate and 1245 is everything else. But that's more of a discussion when we get into sale of assets, because 1245 or 1250 affects how we complete Form 4797, and we'll be talking about that on my Thursday class. So that's when we take a closer look at it. Rental homes are non-residential property? No, non-residential means people don't live in it. Residential means people do live in it. So residential rentals are 27.5 years. I've got lots of questions. Normally my webinar students don't say so much. All right, so we left off at the end of our last session discussing commercial real estate and the fact that there's 39-year life on commercial real estate, except for certain real estate placed in service in that window of time between 86 and 93 that is 31.5-year property. There's also a little notation in here regarding small wares for restaurants and taverns. Small items such as glassware, cutlery, and kitchen utensils, and small appliances costing $500 or less may be expensed in the year purchased and placed in service, even though their expected useful life is going to be slightly greater than a year. So what would a restaurant or tavern do with the cost of these small wares? Well, I probably would put those under cost of goods sold, but if it wasn't there, I'd put it under supplies. Also, 15-year maker's life for qualified leasehold improvements. I kind of laugh about this one because every year it's supposed to expire and every year it keeps getting extended. The first year we had 15-year life on leasehold improvements was 2004. And there's this magic day, October 22, 2004, when all kinds of rules relating to depreciation changed. That was the point in time where the ability to deduct startup costs went from 5-year amortization to 15-year amortization. It's also the point in time where they brought in a restriction on claiming a Section 179 deduction on SUVs. And it's also the point in time where they introduced this 15-year life for qualified leasehold improvements. And at that time, it was only supposed to last 2 or 3 years, and then it got extended, and then it got re-extended, and then it got extended a 4th, 5th, and 6th time. And at this point in time, we're actually, I believe, going all the way through 2012. So this says before January 1, 2012. I believe it actually goes to the end of 2012. Question. What is a qualified leasehold improvement? Wow, I'm going to tell you more about that in a little bit, but in a summary, a leasehold improvement is something that is done structurally to a building that you are leasing for use in your business. So for example, you go in and decide to open up a retail store inside a strip mall, and as a part of that you renovate the interior and you put in a new bathroom and you put in lighting fixtures and you put in a few walls. That would be an example of a leasehold improvement. Now you have to be leasing the property, you can't be an owner of the property. Nor can you be indirectly owning the property, say through a closely related company. It really has to be a true lessee relationship to a lessor. And if it is that type of relationship, then you can write off the cost of those leasehold improvements over a 15-year period rather than 39 years, which is the norm. So if you sign a 5-year lease, but you have to depreciate your property over 39 years, that kind of is not so attractive or not so beneficial to the business owner. But 39 years is the standard, and it is quite a beneficial thing that they allow 15 years for lots of different reasons, which we'll get into. Computer software is another one that stands out. Most businesses use, pardon me, I have a frog in my throat. Most business use property can be depreciated under makers. However, some computer software is intangible property that is not depreciated under makers. And Publication 946, page 10, provides the following instructions for depreciating computer software. The deal with computer software is very few people actually have a clue how to depreciate computer software. And the added confusion is that the IRS in recent years has somewhat changed the rules on depreciating computer software. But here's what Publication 946 has to say. Firstly, intangible property. Most intangible property is amortized and not depreciated. If you can depreciate intangible property, the straight line method of depreciation is generally used. The straight line method lets you deduct the same amount of depreciation each year over the useful life of the property, and if in the first year you use the property for less than a full year, you must prorate your depreciation deduction for the number of months in use. And this example comes straight from the publication. In April, Frank bought a patent for $5,100 that is not a Section 197 intangible. He depreciates the patent under the straight line method using a 17-year useful life and no salvage value. He divides the $5,100 basis by 17 years to get the $300 yearly depreciation deduction. He only used the patent for 9 months in the first year, April through December. So he multiplies 300 by 9/12 to get his deduction of $225 for the first year. And next year he will deduct the full 300. Now here's the deal. When you are deducting property that is not depreciated under makers, you enter it on line 16 of the Form 4562. This is not the section used for claiming makers depreciation or even ADS depreciation. It's a little line for doing other things for depreciation, and the only way you would ever know what goes on that line is if you read the instructions. And if you read the Form 4562 instructions for line 16, guess what it tells you to put there? Computer software. So if you purchase off-the-shelf computer software, that software has a 3-year life. It is not depreciated under acres. It's not depreciated under makers. It is depreciated straight line in a system or under a system similar to amortization. And that is, you don't apply a convention. You don't get double declining balance. You just go straight line over the 3-year life that is assigned to most off-the-shelf computer software, and you stick the deduction once you've calculated it on line 16. If you want more information about that, read the instructions for line 16 inside the instructions for 4562. Certain Section 197 intangible computer software that is acquired with a business. Well, the IRS basically classifies computer software into 2 categories. One of those categories is essentially off-the-shelf computer software. You can go into Office Depot, pick it off the shelf and buy it, or you can go into Costco and it's in those bins at Costco. You pick one out and you go through the cash register and you buy it. They also would include in that same category the type of computer software you might purchase over the internet. It's just a click and buy. It's readily available to the public. There's nothing about it that is customized to your business in any way. It's just a marketable product that you buy. And the IRS says that that is depreciable over 3 years, and you claim that deduction on line 16. The other side of computer software is this Section 197 intangible. And if you have purchased a Section 197 intangible type of software, the IRS generally says you cannot be depreciating it if you acquired it in connection with the acquisition of assets constituting a business or a substantial part of a business. However, computer software is not a Section 197 intangible and can be depreciated even if it is acquired in connection with the acquisition of a business if it meets the following tests. Number 1 is readily available for purchase by the general public. It is subject to a non-exclusive license, and it has not been substantially modified. So what this is saying is if you've essentially got non-modified computer software readily available to the public, and you purchase that software as you are purchasing other assets of a business, you can depreciate that software. But if you purchase a specially designed software that has value in and of itself because it was specifically created for the needs of a particular company, that software is very unique and it is intangible in value and you can't depreciate it. The best you can hope for is to be able to amortize it, probably over 15 years. That would be the best you can hope for. I'm sorry? Is software in the GDS tables? No, software is not in the GDS tables. Yeah, there's a question, can I find software in the GDS tables? And there's certain things that are not in there, but you would read about software in the instructions for Form 4562. Depreciation schedule. Form 4562 is the form used to report and claim depreciation and amortization deductions for business use property. The form provides space to report current deductions and current year depreciation on maker's assets. It also provides space to report a variety of other depreciation and amortization deductions. So 4562 is the form that you use to tell the IRS how much of a deduction you're going to claim for assets placed in service during the current year for certain types of specialized property that has to be reportable every year on a Form 4562. But there are certain years where 4562 is not required, or certain situations where 4562 is not required, in which case you just claim the depreciation deduction straight on the tax form. So a depreciation schedule is very different than 4562, although they work hand in hand. A depreciation schedule is an internal document used by the tax preparer or a business to track each and every asset that is in use in a business and to show how the depreciation deduction for that asset has been calculated and tracked over time. So let's take a look at the types of information that would be tracked on a depreciation schedule. Nancy 3 says, does a website fall into the software category? Well, websites are a tricky one. If you've hired a company to design a very expensive high-end website costing several thousands of dollars, is that an asset that has value, an intangible asset that you've just created that becomes part of the operating part of your business? If so, it's probably something that's supposed to be capitalized and amortized. But if it's really a method of advertising and you're paying a company to maintain it and the purpose of the website is to really market your business, and you're annually, every year, incurring costs for the maintenance of that site, then quite frankly, I would consider a website to be a form of advertising. I have not read any direct IRS information on this. If any of you have seen any court cases or read about anything specific to websites, I'd be happy to hear your input. But that's basically how I treat a website. But yeah, there's going to be some websites, for example, our own school website, that we've got thousands of hours of time into maintaining that site, and it's done on an annual basis, and we redo our website in its entirety probably every other year. So how would you put a life on it of more than a year to 2 years would be difficult. So those things have to be taken into consideration when you're looking at an asset, its useful life. And then another question, are tax preparation software such as Lacert or Profix off-the-shelf software? I would consider Lacert very definitely to be an off-the-shelf software, and my argument about Lacert and any other tax software is it has a useful life of 3 to 4 months for the tax season. It's a license that has to be renewed annually. So I've always taken the standpoint that computer software has a useful life of a year or less, and I've written it off as an expense. Now, you could get into an argument with the software, over the software with an auditor who might argue that, hey, that software technically can be used for the 3 years when you're amending returns. You could get into that argument, but I've just never had to go there. So if any of you have had that audit, let me know how it came out. All right, so we were talking about depreciation schedules and the type of information that should be recorded on a depreciation schedule. And as I'm reading these off to you, I actually have one kind of poking up at the bottom of the screen down here. This is a cutout of a depreciation schedule generated by our software, but it's not necessarily complete, and I've kind of scrunched it so it'll all fit in a line here. But obviously, the depreciation schedule should record the cost of an asset, the date that you purchased that asset and placed it in service in your business, the depreciation system you used, the depreciation method that you used, the class life, the recovery period, the convention, the current year depreciation, any prior depreciation claimed on that asset, accumulated depreciation, current and prior year Section 179 deduction, current and prior year bonus depreciation, and alternative minimum tax depreciation adjustments. In this very last column here, AMT. Now, in today's class, I'm not going to spend any time talking about AMT. We have another class specifically devoted to AMT called Understanding the Alternative Minimum Tax. And in there, we would get into explaining some of the differences and why you would have an entry under AMT depreciation. But today, we're going to be focusing really on maker's depreciation and how we peg a particular asset and put numbers into each of these columns, and then how we pull totals from these columns and then put them on Form 4562. So we keep a depreciation schedule to figure the amount and type of depreciation that we will enter onto Form 4562. But the depreciation schedule is not submitted to the IRS. They don't want it. The other thing about the depreciation schedule is it gives totals. You might list 10, 20, 200 assets on a particular depreciation schedule to arrive at these total numbers down at the bottom. And it's those totals that carry to the 4562 in most cases. It's not the individual lines themselves. Although with listed property, IRS does want you to list every asset that is listed property. For a property that is not listed property, you would just enter totals. Speaking of Form 4562, it's time to start taking a closer look at that baby. It's one of my favorite forms. We're just going to take it section by section so that when you look at a line on Form 4562 and there is a number on that line, you know why. You know why that number is there, and if it doesn't belong there, you can figure out how to get rid of it. And if it's the wrong number, you know how to fix it, because that would be the ideal, that you understand depreciation so well you can go into your computer software and tell it what to do. And actually in class, during our break, some of my classroom students were saying, now what about how do you do this stuff in computer software, or how does this work in computer software? So what I will do today when I find a good opportunity for it is I will take you into the software we use, which is Drake software, and show you how I control depreciation outcomes using Drake software. Now, it's not obviously going to tell you how to do it in Lacert, but it might help you understand how software in general works and how you can look to see whether your depreciation entries are doing what they're supposed to in carrying to Form 4562 and carrying to the tax return itself. So, except as otherwise noted, complete and file Form 4562 if you are claiming any of the following. Depreciation for property placed in service during 2011. a Section 179 expense deduction, which may include a carryover from a prior year. Depreciation on any vehicle or other listed property, regardless of when it was placed in service. So what we're talking about here initially is, when is the form required? Because you are not always required to attach the form to your return. These are the situations when you must attach the form. So again, if you place an asset in service during the year, the form is required. If you claim a Section 179 deduction, including a carryover during the year, the form is required. If you claim any depreciation on any vehicle, regardless of when it was placed in service, the form is required. The only exception to that is a deduction for any vehicle reported on a form other than Schedule C. So if you're claiming a deduction for a vehicle on Schedule C, the form is not required, because Schedule C actually has space to enter business use of automobile information. You can do it there. But any other type of auto expense for depreciation that you claim, or any auto expense in general, period, that you claim on any other form, such as Schedule E, or 1120S, or Form 1065, or Schedule F, those would be examples of where Form 4562 has to be attached if you were claiming expenses relating to automobiles. Any depreciation on a corporate income tax return other than Form 1120S, and amortization of costs that began during the 2011 tax year. You need to file a separate Form 4562 for each business or activity for which the form is required. If you need more space, attach additional sheets. However, complete only one Part 1 in its entirety when computing your Section 179 expense. And I don't have Part 1 up in front of you, so I'm just going to flash to that real quick so you can make sense of what I'm saying. So let's go back to page 53 of our manual here. That would be, back into the manual to page 53. And we will see here that Part 1 has to do with entries for the Section 179 deduction. And IRS says even if you have multiple Form 4562s attached to your return, you will complete Part 1 in its entirety only once. They don't want you filling it out start to finish every time. But there would be certain information claimed on 4562 more than once in Part 1, but all of Part 1 completed in its entirety is only ever done once. And how you go about completing it only once, I don't have a specific example of that, but we'll take a look at the Part 1 a little bit later in today's class. So I just wanted to point out Part 1, that you only fill that out in its entirety once, but all of the other parts of the form are filled out in their entirety as they relate to the particular form that you're completing. So for example, if I'm completing Form 4562 to carry to a particular Schedule C, and I have assets that I placed in service under makers, then I will fill out Form 4562 Part 3 with all of the relevant information for that particular Schedule C. And if I have a different business, a second Schedule C, and I have separate assets placed in service for that other business, I would fill out a second Form 4562 that carries to that business, and so on and so forth. Back to page 11. I like to move around and then I don't remember where I was. So we were right here. I see a couple questions popping up. If each spouse has their own Schedule C, wouldn't you complete 2 Form 4562 Part 1s? The answer is a husband and wife share the Section 179 deduction limits, and so you would probably still fill it out only once. This is assuming a joint return. If they file separately, obviously, that would be different. Okay, figuring and claiming maker's depreciation. Maker's depreciation is taken in Part 2 of the form, so even though Part 1 and 2 come first, I'm starting with Part 3. And I feel the biggest or the best way to understand maker's depreciation is to take a look at the form, how it's put together, and then basically go section by section. How do we know what amount to put in each of these columns? We claim maker's depreciation by completing Part 3 as follows. In Section A, which is this top section in yellow, you enter depreciation deductions for assets that were placed in service in earlier years. This is what is interesting. Line 17, you enter maker's deductions for assets placed in service in tax years beginning before 2011. There's no space there to identify which asset is being depreciated, how much you're claiming on that particular asset. It's one number for everything, because all of that is tracked on the depreciation schedule, and the depreciation schedule is never sent to the IRS. But an IRS auditor would, of course, ask for it if your client was being audited. Then we have on line 19 all of the depreciation that is going to be taken for assets placed in service in the current year, except when we're depreciating assets using the alternative depreciation system. And if we're using the alternative depreciation system, then assets placed in service in the current year are reported on line 20. So let's take a look at the columns here for line 19. The first thing we'll see for line 19 is it classifies the assets into their life: 3-year property, 5-year property, 7-year property, 10-year, and so forth. You'll see that we get down to residential rental property, and it's already filled in the recovery period at 27.5 years for you. And for non-residential real property, it's already filled in the recovery period as 39 years for you. You'll observe that for residential and non-residential rental property, it's also filled in the convention, because those are fixed and don't fluctuate. And that the method is also filled in as straight line, because that's fixed and does not fluctuate. When you go under acres, or not acres, but ADS property, you've got two choices: 12-year property or 40-year property. That makes it real simple, doesn't it? And they've already filled in the recovery period for you as either 12 or 40. And if it is real estate, then it is mid-month convention, straight line. And whether it's real estate or personal property, it is still straight line, so that's filled in. But up on line 19, lines 19A through 19I, you're given a few extra choices. Actually, I've already told you not on 19I, but let's start with 19A through 19F. You're given more choices because everything is blank, and it's the tax preparer's job to figure out what gets to go in those blanks, including deciding the classified life of the property, the month and year the asset was placed in service, the basis or cost for depreciation, the recovery period, the convention, the method, and the final deduction itself, the number that you put in column G, that final deduction. And as I've already said, you use the classification tables in Appendix B to figure out the class life of the property and the depreciable life of the property. The next piece of terminology we're going to get into is depreciation convention. This is an election year, so we're going to have national conventions on television, right? There's going to be the Democratic National Convention, and there's going to be the Republican National Convention, right? Well, this is the depreciation convention, folks. We're going to be here casting our votes in the depreciation convention. So, in applying either acres or makers depreciation methods, you must first determine which convention applies. The depreciation convention determines what date your asset will be treated as having been placed in service, and there are 3 conventions. So there's the date that we actually buy the asset, right? And then there's the date the IRS says we bought the asset, and they're not the same. And the convention that we use is going to determine what date the asset is treated as having been placed in service, regardless of the date it actually was bought. So the 3 conventions include the mid-month convention, the half-year convention, and the mid-quarter convention. Let's talk about mid-month first. This convention applies to residential and non-residential real property. Under the mid-month convention, any asset placed into or taken out of service during any part of the month is treated as if it was placed in service in the middle of the month. In this calendar, I chose the 15th. Here's an illustration. You purchased a residential rental property on April 3, 2011. Under the mid-month convention, that property shall be treated as placed in service on April 15th and will be allowed 8.5 months of depreciation for the year. Half-year convention. This convention applies to property used other than for rent. An asset placed into or taken out of service during any part of the year is treated as if it was placed in service or disposed of in the middle of the year. Here's an illustration of the half-year convention. You purchase a photocopier for $5,000 on November 11, 2011. Assume that the total value of all assets placed in service during the last quarter of the year was less than 40% of the total of all assets placed in service for the entire year. You have to make this assumption because it's important. Under the half-year convention, the copier will be treated as placed in service on July 1st and shall be allowed 6 months of depreciation. So for example, what is the useful life of a computer? The depreciable life of a computer? 5 years. If we're to depreciate a computer over 5 years straight line, and that computer cost us $5,000 because it's a nice baby, right? that would equate to $1,000 a year, wouldn't it? 5 divided by 5 is 1,000, even with April's math, which is always questionable. But under the half-year convention, I don't get $1,000 in the first year. I only get half that, $500. Let's talk about the mid-quarter convention. This one's probably the hardest one to calculate, and one that your computer will figure for you if you're not paying attention, and you may not even realize it's done it. Because computers are pretty good at figuring out what date you put in there, and if you put in enough dates that are at the end of the year, it will apply the mid-quarter convention probably without you even realizing it or understanding why. But here's the why and how of the mid-quarter convention. The mid-quarter convention applies when more than 40% of assets that are eligible for the half-year convention are placed in service in the last 3 months of the year. That would be October, November, December, unless you are a fiscal year filer. So for calendar year filers, the last 3 months of the year are October, November, and December. So you look at the total cost of all property placed in service in the last 3 months of the year. What's that total cost? And then you compare it to the total cost of all assets placed in service for the entire year. And if the final quarter of the year has costs that are greater than 40%, the mid-quarter convention automatically applies. But it only applies when you're looking at assets that are ever eligible for the half-year convention to begin with. So don't be figuring the cost of real estate into that equation, because real estate doesn't qualify for the half-year convention in the first place. You'll see what I mean in a little illustration coming up. So you must apply the mid-quarter convention instead of the half-year convention if more than 40% of the assets placed in service during the year were placed in service in the last 3 months of the year. Here's an illustration. You purchase the following assets during the year. A photocopier, which is 5-year property, costing $5,000. You purchased it on February 11. You also purchased a printer, which is also 5-year property, costing $1,000, and placed it in service on May 11. So 5 plus 1, that's $6,000, placed in service in the first half of the year. Then we moved down and we purchased another computer as 5-year property, costing $3,500 on November 11th. And furniture, 7-year property, costing $2,500, placed in service on December 1st. And here we have another $6,000. So 6 in the last 3 months of the year, 6 in the first half of the year. That means that 50% of the assets were placed in service in the last 3 months of the year. That's more than 40%. It means the mid-quarter convention applies. So how does the mid-quarter convention work? Well, under the mid-quarter convention, all assets placed in service during the year shall be treated as placed in service in the middle of the quarter in which they were placed in service. So for the photocopier, which was placed in service in the middle of the first quarter, where it was actually almost on the middle, because the middle of the first quarter would be February 15, right? And it was placed in service on February 11th. It could have been placed in service on February 1st, January 30th, March 10th. It wouldn't matter because it was placed in service in the first quarter. It will be treated as placed in service in the middle of the first quarter, and that means you would get 10.5 months of depreciation for that computer. The next asset is the printer, and it was placed in service in the second quarter, and it will be treated as placed in service in the middle of the second quarter. And both the second computer and the furniture were purchased in the final quarter of the year, and they will be treated as if they were placed in service in the middle of the final quarter, so they get only 1.5 months of depreciation each. So we're going to claim 10.5 months of depreciation on the photocopier, 7.5 months on the printer, 1.5 months each on the computer and the furniture. So how exactly does that formula work? Well, you remember under the half-year convention, we took that $5,000 computer, divided it by 5 years to get the straight-line depreciation amount of $1,000, and then we multiplied that by 50% and got $500. Well, the formula is a little bit similar, but slightly more complicated for mid-quarter convention. In this case, we take that $5,000 photocopier and divide it by 5 years, and when we do that, we get $1,000 per year. But we're not done. Instead, we have to take how many months there are in a year, and we're going to divide that by 12. And then how many months of depreciation do we get for the year? Well, for an asset placed in service in the first quarter, we're going to get 10.5 months. So we're essentially going to go 5 divided by 5 multiplied by 10.5 divided by 12. And when we do that, we get first-year depreciation of $875. We then move down and we have a printer costing $1,000 divided by 5 years. We multiply that by 7.5 divided by 12, and we get $125. The computer is $3,500 divided by 5 years, divided by 12, multiplied by 1.5 months, and we get $87. And that same exact formula applies to the furniture, except that the furniture is 7-year property. So we're dividing 7 years into $2,500, and then we're multiplying that by 1.5 divided by 12, and we get $46. Now, if I were to go into my computer software, would my computer software fill out a depreciation schedule that has exactly these numbers? The answer is yes, within $1, depending on how rounding goes. I rounded these specific to the formula that you see in front of you, but computer software works off of tables usually, and the tables will give you slightly different numbers, sometimes $1 off. So if you end up seeing your computer software is $1 off for me, that would just be because the software went to the tables, and the tables are in here. Publication 946 has tables. Let me find some. It has tables for the conventions. It has a half-year convention tables, and it has straight line tables, and it has mid-quarter convention tables. And here I have in front of me on page 76 of the manual the start of the mid-quarter convention. And it has a column for 3-year property, 5-year property, 7-year property. So if I purchase an asset and place it in service, and it's 5-year property, and I place it in service in the first quarter, it's giving me a percentage that I'm going to use. And software will pull the percentage. And the percentage might be slightly different than I get through a manual calculation of the formula. Now, wouldn't it be good if you got to do this yourself to have it all make sense to you? I thought it would be, so I decided I'd give you a few minutes to work through an assignment of your own and figure manually, based on everything I've taught you so far today, the depreciation on these 4 assets. A rental house after the land value has been subtracted, costing $150,000 and placed in service on April 15, 2011. Also a washer, carpet, and furniture. These are their dates placed in service, and here's the cost of these assets. And you can assume that all of these assets were placed in service during the year in a rental activity. So they're all on the same 4562. Go ahead and figure the amounts to enter for depreciation and the formula you use to calculate that amount. And we'll take a look at this problem. So the first question I have is, which convention applies? The mid-quarter convention or the half-year convention? If you think it's the mid-quarter convention, give me a green check mark. And if you think it's the half-year convention, give me a red X. Okay, I don't have anyone falling for the red X. That's good. You were paying attention. Okay. There's lots of students over the years who fall for this rental property, and they say, but most of the assets were placed in service in the first part of the year, not in the last part. But we have to remember the rule that the rental property would never be eligible for the half-year convention anyway, so we throw it out. And what we're left with is assets where we can see are very heavily weighted to the last 3 months of the year. So the residential rental house, we're going to depreciate that straight line over 27.5 years, and we will apply the mid-month convention. On the washing machine, we're going to take that straight line over how many years for residential rental property? What's the life of assets placed in service in a residential rental? 5 years. So if you placed a washing machine in use in a laundromat, that would be 7-year property. But if it's placed in service in a rental property, it's 5-year property. It's just a weirdism of the IRS rules that you have to learn. All right, and then if we flip to page 64 of this manual, I actually have that table filled out for you. So let's go do that together. And here it is. We'll zoom in on it a little. So we can see that the rental house has a date placed in service with a cost of $150,000. We're going to take $150,000 and divide that by 27.5 years. And then because it's the first year it's placed in service, we're also going to have to look at the mid-month convention. There are 12 months in a year, so we divide 150 by 27.5 by 12, and then multiply it by the number of months that the house was in service during the year, and that is 8.5 months. And that gives us $3,864 of depreciation. Then we go over to the washing machine. This is also being recovered straight line, and that is going to be 500 divided by 5 years, divided by 12 months, multiplied by the number of months that is treated as having been placed in service. Actually, that should be 4.5, shouldn't it? 4.5. 4.5. I have a typo here. I was up at 10 o'clock last night. There's my excuse. But that should be 4.5, yes. 7.5. Let me see. You take 3.5 out of 12. 12 minus 3.5 is what? 12 minus 3.5 is 8.5. I got the first one right. Because you're getting half of April, and you're getting all of January, February, March. So it's 3.5 months you're getting, subtracted from 12. So I said April's math is never that wonderful, but that one I got right. And then this one here should be 4.5. Let me see what my formula gives me. If I go 500 divided by 5 divided by 12 times 4.5, I get 37, not 29. So this should be 37. And then on the carpet, we have 2,000 divided by 5 years, multiplied by 1.5 months, divided by 12 months, and that gives us $50. And then on the furniture, we have 1,000 divided by 5, divided by 12, multiplied by 1.5, and you should get 25. So I was trying to think of an easy way to remember these mid-month convention rules, but you would just keep adding 3. So 1.5 plus 3 would give you 4.5. 4.5 plus 3 would give you 7.5. 7.5 plus 3 would give you 10.5, right? So I was looking at the 3.5 going, dang, that doesn't work. Because I know that 1 plus 3 is 4. I learned that in first grade, although I struggle still today. All right, then we go back to the manual. And we've just been learning about the conventions. We've attended the convention. And now we're going to start applying methods. And actually, we have been applying a method. We've been applying the straight line method so far today because the straight line is the easiest to understand. But now we're going to learn about the other methods. And actually, the most common method used is not straight line. It is a double declining balance is the most common method used. Password number 2 is PERTH. P-E-R-T-H. PERTH. So we're now at the top of page 14 looking at depreciation methods. Both acres and makers allow a business to claim depreciation on certain property using either of the following methods. The first one is straight line, and that's what we've been playing around with. And the other is something called accelerated depreciation. Under the straight line method, the cost of property is recovered equally over time. This means the deduction claimed is the same amount every year. Under the accelerated method, the cost of property is recovered unevenly over time so that more depreciation is claimed early on and less depreciation is claimed later. How do we apply makers? Well, makers doesn't in itself dictate the method of depreciation that you're going to use. You still have a choice. But depending on the type of business you are, and how makers applies to the type of business, your computer software will typically default to the either the required method or the most commonly chosen method, the default method, you could say. So the straight line method automatically applies to residential and non-residential real property. The computer software will always default to straight line because that's the only choice you have. Most other types of assets that are depreciated over 3, 5, 7, 10, and 15 years qualify for 200% declining balance, so it's probable that your computer software will default to that. Actually, 15-year property is not 200% declining balance. 15-year is 150% declining balance.
Let me correct that. 3, 5, 7, and 10-year property should default to 200% declining balance unless you are a farmer. And for farmers, 150% is what they get. But every other type of business should default to 200% declining balance. And then 150% declining balance is for farmers, period. No matter what they're placing in service, they're probably going to fall under 150% unless they're straight line. And 15-year or longer life on property that does not require straight line and is allowed accelerated depreciation. So for example, if you put in a fence deck or a patio on a residential rental property, that would be an example of 15-year property, and it would be depreciated with 150% declining balance. Maker's straight line, we're going to take a look at that first. Straight line depreciation is optional for some classes of property and required for others. The following property must be depreciated straight line, and that is residential real property over 27.5 years and commercial real property, including office in the home, 39-year property. I've included office in the home here to make that stand out because the type of error I see people do, tax preparers and homeowners alike, is they'll depreciate a home office over 27.5 years because it's, well, in their home and that makes it residential. But IRS says it's the use of the property that dictates whether it's commercial or residential, and a residential rental is a home that someone lives in as their home, and a commercial rental is a property that is rented for use in a business. And if you're using your home office for business, that would be commercial, and that means it's 39 years. Makers 3, 5, 7, 10, 15-year assets can also be depreciated straight line. To depreciate 3, 5, 7, 10, or 15-year property straight line, you must make an irrevocable election to depreciate all assets of the same class under the straight line method which were placed in service during that same year. I worked hard to make that sentence easier to understand, and I gave up. Straight line illustration. You purchased a new computer in 2011 for $2,000. You can depreciate the computer using the straight line method over 5 years, or you can use the double declining balance method over 5 years. Under the straight line method, you depreciate the computer in equal amounts over a 5-year period. Straight line depreciation is a good choice if you would like to see the cost of an asset spread equally over time. So here we go. Purchase price $2,000. Straight line depreciation would be $2,000 divided by 5 equals 20%, or $400. We apply the half-year convention, which means we only get half a year of depreciation in the first year, and that means the first year depreciation under straight line would be $200. And then in the second year, we get the $400, and in the third year, and in the fourth year, and even in the fifth year. And then in the final year, we get that final $200. So here's the accumulated depreciation. $200 in the first year. By the end of the second year, we've claimed $600. By the end of the third year, we've claimed $1,000. At the end of the fourth year, we've claimed $1,400. At the end of the fifth year, we're up to $1,800. And in that final year, we make it all the way to $2,000. And that computer is fully depreciated. Here is the formula and how we calculate it. And essentially, the rate of depreciation is 20% all across the board, except in the first and last year, we get half of 20%, because the half-year convention is giving us half the full year depreciation in the first and final year. And I even put a nice little table here so you could see how balanced the world is when you go straight line. Year 6 and year 1 look exactly the same, and everything else in the middle is twice that of first and last years. Couldn't get simpler than that. Now, you can elect straight line when it's not required. If you decide to elect straight line, you would have to go straight line for every asset placed in service in that class. Here's an example of what I mean by that in case you're still foggy. You decide to depreciate your new computer purchased in 2011 over a 5-year period straight line. In making this election, you must also depreciate all other assets of the same class that were placed in service during 2011 using the same straight line method. You cannot use straight line depreciation for your new computer and then use accelerated depreciation for your new printer purchased during the same year because they belong to the same class. But you could, however, choose straight line for your printer and computer and then go accelerated depreciation for your office furniture because office furniture belongs to a different class than office equipment. Why would you want to do that? Well, here's the deal about depreciation and where we can become useful as tax preparers. A, not only do we understand how to do depreciation so we can get it done correctly, but we can also use depreciation choices or decisions to manipulate the outcome of a profit on a tax return. We can use depreciation to increase a loss or reduce a profit. We can also say, hey, this business didn't generate a lot of profit next year, but we see good things on the horizon for next year, so let's make some depreciation decisions that are going to save the deductions for future years and try and minimize what we're doing this year. So depreciation is the one place where we really have a lot of control over the outcome of a tax return. Now we're going to talk about makers, 200 and 150% declining methods, but I see we're coming up close to the top of the hour, and I bet you there's a few people out there screaming for a break. Thank you, Rumpelstiltskin. I see. Yeah, we were here in the class. We were discussing this 5-year property, and yes, it is on page 36 of publication 946, and then I also knew it was in publication 527, but you found the page. The question was the life of carpet. Yeah. 5-year life on carpet. Why do I need to know that? Well, when we're tax preparers, we need to know all kinds of trivial pieces of information like the useful life of carpet. Now, I have a brother-in-law down in California who's a farmer, commercial farmer. He's got a pretty big operation running. Several years ago, I was down there sitting next to him. I hadn't been in taxes as long back then. We're probably talking over a decade ago. And I'm sitting in the sofa next to him as we watch a football game on his television set. And he turns to me and he says, "What's the depreciable life of a tractor?" And then he says, "What's the depreciable life of this? And what's the depreciable life of that?" And I answered each and every question accurate, and he went, "Just testing." The farms are not my expertise, but I had the farming life correct. All right. So back from break, and my well-trained webinar students are already giving me check marks to say, hey, I'm here, thank you. So those of you who still need to give me one, you could go ahead and do that. And are there any questions for me before we head into the next topic in greater detail, figuring 150 and 200% declining balance? So if not, let's move on. So we talked about straight line and how to work straight line. And 200% and 150% simply take whatever number you calculated using straight line and multiply it by 2 or by 1.5. So in effect, in the first year of depreciation, the formula says whatever depreciation you calculated straight line, under double declining balance, you're going to multiply that total by 2 or 200%. And under 150 declining balance, you will multiply that difference by 150% or 1.5. So in effect, Makers has 2 different declining balance methods to choose from. Some people are forced into 150% declining balance because if you're a farmer, for example, you are. And all other businesses typically are going to use 200% declining balance unless the business chooses to go 150. It could do that. 200% declining balance is applied to 3-year property, non-farm, 5-year property, non-farm, 7-year property, non-farm, 10-year property except fruit-bearing trees and vines. The 150% declining balance method applies to 15-year property, 20-year property, 3, 5, 7, and 10-year non-farm property, if that's the method you choose to apply, and then all farm property except real property. And you can reference this information in Table 4.1 of IRS Publication 946, which is on page 43. 200% declining balance is a method of accelerated depreciation, and under this method you are allowed to recover more of your cost early on. Specifically, you are allowed to claim 200% of what normally would be allowed under the straight line method in the first year. But after the first year it gets confusing, and this is how I worked to figure out what was going on after the first year. Each year after the first year, you are allowed to claim the remaining unclaimed balance at the same rate using the Makers depreciation tables. The tables are designed to work according to a set formula, and it's only by taking the numbers and working backwards that you actually figure out what the formula is. I'm sure it's written in the code somewhere, but if at all possible, we would avoid actually reading the code, wouldn't we? So I'm sure it's in the code, which I've never read. So I just took the tables that are in the publications and worked backwards to come up with these numbers. So the table's designed to work according to this formula over the useful life of the asset. However, depending on the life of the asset, the formula will typically change to straight line after about the 4th year. And here's an illustration of how 200% declining balance actually works. You purchase a new computer during 2011 for $2,000. You can depreciate the computer using the straight line method over 5 years, or you can use the double declining balance method over 5 years. The 200% declining balance method allows you twice the first year depreciation allowed under the straight line method. The intention of 200% declining balance is to allow greater depreciation early on and less depreciation later. So let's take a look at it. Purchase price $2,000. 200% declining balance would allow you 40% of the first year of depreciation rather than 20%. But of course, we still have to apply the half-year convention, so oddly enough, the first year is back to 20% again. But under straight line, the first year would be half of 20% or only 10%. Make sense? So here is a table where I show you the logic of how double declining balance works. Here we have year 1 where we've purchased and placed in service that $2,000 computer. The first year depreciation under double declining balance is $400, which is 2,000 times 20%, or you could take 2,000 divided by 5, divided by 2, multiplied by 2, right? That's what's essentially going on. And either way you cut it, you still end up right back at that $400. But the way declining balance works is my declined balance is the purchase price minus the depreciation I've already claimed. And if I do that, I would take 400 and subtract that from 2,000. And if I were to do that, then I multiply the difference, which is 1,600, by 40%, and I get 640. Now, if you go to the maker's tables, they'll tell you that the second year of depreciation on 5-year property is 32%. It's actually 40%, but you have to subtract out the depreciation already claimed. And it's so what they're doing is 40% of the remaining balance, or 32% of the original cost. So the 40% calculation is always going on the remaining balance. And the tables don't go on the remaining balance. They simply go to the original cost and multiply it by the percentage allowed. So on that computer, the first year we get 20% of 2,000. In the second year, we subtract 400 from 2,000, multiply that difference by 40%, and we get 640. If you take $2,000, multiply that by 32%, you get 640, oddly enough. And then we go 2,000 minus 1,040. Where does that come from? Well, we go 400 plus 640. That's 1,040. So 1,040 of the 2,000 has already been claimed. That leaves us with 2,000 minus 1,040 as our remaining balance. And that, too, is multiplied by 40% to give us 384. Or, to keep life simple, you could simply go to the tables and multiply the original cost of 2,000 by 19.2%, and you get the same number, 384. Isn't it exciting? Okay, then in the third year, what is it, this is the fourth year? We're going 2,000 minus 1,424, and 1,424 is 400 plus 640 plus 384. That's that 1,424. Then we multiply that total by 40%, and we get 230. Or we could just go to the tables and go 11.52 times 2,000, and we get that same 230. But here's where it all goes to heck. They just flip the straight line, and they say that year 5 is the same as year 4. And in the final year, you get what's left, which is this 5.76%. Now, this is the only such illustration I have in there. You could easily work your way through any of the tables in there for 7-year property, 10-year property, come up with similar computations. But this was how, back in 1993, I figured it all out to make it make sense to me. And that's how I continue to make sense of it to this day. Now here is an accelerated method of depreciation chart, and we're starting at the bottom. In year 1, we're allowed 20% depreciation. In year 2, we get that 32%, which is actually 40% of the remaining balance. And in year 3, we're getting 19.2%. In year 4, we're getting 11.52. In year 5, we're getting 11.52. And in that very final year, we're getting that 5.76, which happens to be half of 11.52, something like that. Now let's line those two depreciation systems up next to each other, two depreciation methods up next to each other. Here we have the straight line method lined up next to the double declining method and the accumulated depreciation on each of these as we go through. So for an asset placed in service in 2011, under the straight line method, that first year would give us $200. And under Maker's double declining balance, we would get $400 because it would be twice that of straight line. In the second year, straight line gives us $400, and double declining gives us $640. In the third year, straight line gives us $400, but look at that. By the third year, double declining balance is giving us a smaller number. Because at some point, double declining has got to be less than straight line for them to total the same at the end, and it actually happens in only year 3. And as we go through, we'll see in the final year, under double declining balance, our deduction is quite small, only 115 compared to 200, and the year before at 230, it was almost just half of what straight line would have given us. But in the end, we get to the bottom. We have $2,000 under straight line and $1,999 under Makers. I would assume somehow in the computations, my computer software either makes up that missing dollar or the government keeps it. I've never done an analysis of that. It wouldn't surprise me if the government keeps it, because those pennies add up, you know. Makers tables. Now, I've just shown you how to do this all manually, but there are tables that the IRS has put into Publication 946 to make it easier for you. I've simply been showing you the methodology of how double declining balance works and the difference between double declining and straight line. But here are the tables. We have 5-year Makers table, 200% declining balance property. All of those percentages we just went through are right here. 20%, 32, 19.2, 11.52, and 5.76. Now, that's the half-year convention. If we were depreciating under the mid-quarter convention, that first quarter would give us 35%. That's assuming double declining balance. If we were going straight line, you'd get half of 35%. So in the illustrations we did earlier, the table would give us a number that's twice as high as we actually claim under straight line. But if we're going double declining balance, this is where the 35% comes from. Yes? What are you at? Why is the 5th year the same as the 4th year? Because in the final 2 years, the methodology of the IRS tables is it switches to straight line. Or it switches, yeah. There's a student in the classroom asking me, why are these 4th and 5th years the same? And you just have to ask the government why they did that. I don't know why they're the same. They just are. So, yeah, that's the way they've done it. I'm not a mathematical genius. I only figure out the most rudimentary stuff, but someone who's really, really smart with numbers came up with all of these systems, and I've just tried to decipher them as best as my little brain can do it. All right, here's the 7-year Makers tables, and you can see 7-year property obviously is not going to be giving us as big a numbers. Under 5-year property, the first year gives us 20% with the half-year convention, but under 7-year property, we're getting 14.29%. In the second year under the half-year convention, we're getting 32%, and under 7-year property, that same convention is giving us 24.49%. And of course, the mid-quarter conventions are following off on the side. Every one of these is assuming double declining balance in these tables until we get to 15-year property. And under 15-year property, we're applying a half-year convention with 150% declining balance. Now, let's just kind of play around. I kind of thought about this overnight that I should have put another illustration in here, and I didn't do it. But let's just make one up while we're here. Let's suppose we have an asset, a fence that we put in, costing $10,000. And that fence is going to be 15-year property. Let's manually figure out the depreciation that would come into play under the half-year convention. So to do that, we would take the $10,000 cost of the fence, and we would divide that by 15 years. And then we would, in the first year, have to multiply that by the half-year convention, which would be 6/12, or 50%, right? And then we would multiply that by 150% for the 150% declining balance. So if that formula is working, I should get the same number as taking a 10,000 and multiplying it by 5%, theoretically. So 10,000 divided by 15 times 50% times 1.5 equals $499.99 forever. It goes here, equals 499.9999 is what my calculator gives me. And if we take 10,000 and multiply that by 5%, we get $500, don't we? So that's the difference between double declining balance and 150% declining balance. It's just that final multiplication is going to be by 1.5 rather than 2. All the way through. 27.5-year makers tables is the next table that we're looking at. And of course, this table literally goes on for 27.5 years. And I'm not going to put 27.5 years of table in here. So I just gave you the first 6 years. And the same is true with these other tables. I just knocked you off at 6 years on each and every one of them. So you'd have to go to the publication 946 to see the rest of the tables. But I just wanted to give you an idea of how it works. Now here's the thing with residential real estate. It's straight line, and the only time you're going to have a variation is in the first year, because every year after the first year it's always the same number, right? It will never change, because after the first year you're simply going to take the acquisition cost of that property, divide it by 27.5, and that's your depreciation for every year except the first year and the last year. So the only years you're really concerned about a difference is going to be the first and last years on that rental property. Okay, so we've just finished teaching you a whole bunch of information about makers, straight line versus accelerated depreciation. We've taught you about the conventions. We've taught you about the systems. Now we're going to muddle it all up and introduce something called the special depreciation allowance, which basically throws out some of those rules or augments, adds to, adds confusion. Depreciation, or the special bonus depreciation allowance, is something that was originally introduced under President Bush, because of course when Bush came into office, we were in the dot-gone era. Remember, under Clinton things were pretty good economically. The economy was doing really, really well, particularly on the stock market with all the high-tech industries, and all of those started to go belly up, in my opinion, because of excessive trading and overzealous trading on these stock markets, and they were all crashing right as Clinton left office. So Bush came into a rather lousy economy. The economy was doing quite poorly in every aspect except real estate, which oddly was doing well, probably because people were borrowing on their houses to stay afloat. And that helped the economy go for a little bit longer until we had the crash in 2008. But at that time, Bush brought in this bonus depreciation system that allowed companies or businesses to take big write-offs early on for investments in equipment. Now, bonus really has a bigger impact on big businesses because smaller businesses already have the Section 179 deduction there to help them. So bonus was a big deal and remains a big deal to businesses that would use up the Section 179 deduction or aren't eligible for it. There's not the same kinds of restrictions on bonus that there are on Section 179. And we're going to talk about both systems separately. So we're first going to talk about the special depreciation allowance, and then obviously it'll be timed for our intermission for 1 hour, and then we'll move on to a discussion of Section 179. The special depreciation or bonus depreciation allowance allows businesses to claim additional depreciation deductions for certain qualified property placed in service in certain years. And under Bush, after the September 11, 2001 terrorist attacks, because he came into office when it was a lousy economy and 9/11 made it even worse, and that's when they brought in the bonus depreciation. And when it was first introduced, bonus depreciation was 30%. And apparently it worked quite well enough that they decided, let's make it even bigger and better. And they then, within a year or two, switched to 50% bonus. But all of the bonus options for most businesses expired for years after 2004. And in fact, as a tax school teacher, it was like, okay, I had all of this information on how to calculate bonus in all of my tax school classes, and I kept it in there for 5, 6, and 7, thinking, you know, there's still assets placed in service. I still need people to understand how this bonus works. But I was about to remove it from my manual when they brought it back in 2008. And so beginning in 2008, bonus returned, this time as 50% bonus. And then when the Small Business Job Act was passed in December of 2010, they introduced a 100% bonus. So for assets placed in service after September 8, 2010, and before December 31, 2011, we have 100% bonus depreciation. And now that we're into 2012, as I'm teaching this class, we're sitting in the calendar year 2012, we no longer have 100% bonus for assets in 12, but we still have 50% bonus through 2012, unless, of course, something happens to extend it again. Who knows what this year will hold? I don't see or hear any politicians talking about anything on the news about any legislation this year being passed. It's just not a topic I'm hearing about. But then again, I've been so busy writing my tax school classes, I haven't had time for the news. So if they've been discussing this on the news and I've just missed it, let me know. All right, so let's take a look then at what kind of property qualifies for this special depreciation allowance, or you could say also known as AKA bonus. So if you hear me say bonus or you hear me say special depreciation allowance, I mean the same thing. And if you're reading a publication or you're reading instructions or you're hearing people talk and they say bonus depreciation, they are referring to the special depreciation allowance. Okay? So the type of property that generally qualifies for special bonus depreciation includes maker's assets with an assigned recovery period of 20 years or less, computer software that is not a Section 197 intangible, and qualified leasehold improvements to non-residential real property. To be eligible, the property must be certain qualified property acquired after September 8, 2010 and placed in service before January 1, 2012. Also, specified Gulf Opportunity Zone or GO Zone extension property, qualified reuse and recycling property, qualified cellulosic biofuel plant property, qualified disaster assistance property, and certain qualified property placed in service after December 31, 2007. The special depreciation allowance does not apply if the alternative depreciation system, ADS, is required to be used. However, if you elect into ADS, you can still claim the 50 or 100% allowance as appropriate. Certain qualified property acquired after September 8, 2010. When you're reading through publication 946, it's dividing property that seems to be very similar into two categories. And essentially, there's bonus rules that apply to depreciable assets placed in service between September 8 and the end of 2011. So between September 8, 2010 and the end of 2011, there's a particular category of property that qualifies for bonus, and when it does qualify for bonus, it's usually 100%. And then there is another category of property that qualifies for bonus that was placed in service outside of those dates that also qualifies for bonus under rules that sound very, very similar. And ultimately, in the end, the difference is one set gets 100% and the other set gets 50%. So you're scratching your head going, this all sounds the same to me. Well, it is all the same, except for the time it's placed in service is going to dictate whether it gets 50% or 100%. And aside from that, there are some very subtle differences that if you sit there and study it long enough, you might notice. All right, so for property acquired after September 8, 2010, you can take 100% special depreciation allowance. You can take the allowance if the property meets the following requirements. Number one, it is one of the following types of property. Tangible property depreciated under makers with a recovery period of 20 years or less. Water utility property, computer software that is readily available for purchase by the general public, and qualified leasehold improvement property. You must have acquired the property by purchase after September 8, 2010 with no binding written contract for the acquisition in effect before September 9, 2010. So what this is getting at is the whole purpose of this particular law was to spur investment. And if you had already made a decision to purchase by signing a written contract to make that purchase prior to the passage of this law, then you cannot make the argument that the law spurred you to the purpose, I suppose. So if you already had a binding contract in place, then you're not going to be eligible for 100% bonus, but you would probably still be eligible for 50% bonus. And of course, if you enter into a binding contract after September 8, 2010 and before January 1, 2012, To acquire, including to manufacture, construct, or produce certain property with a long production period, then you get additional time. So if you placed an order for a commercial aircraft to be built for you in 2011, it's foreseeable that that aircraft will not finish construction by the end of 2011, that it's going to be finished and delivered to you sometime in 2012, and the IRS is still going to allow that 100% bonus as long as you entered into the contract during that window of time on a long production item. But most items that are not long production, you have to enter into the contract and acquire the property in that window of time between September 8, 2010 and December 31, 2011. Also, the original use of the property must begin with you after September 8, 2010, and it is not accepted property. And I'm not even going to get into accepted property. If you want to read that, go for yourself, page 29 of 946. Certain qualified property acquired after December 31, 2007. So property that was placed in service in 2005, 6, and 7 generally does not qualify for bonus. There are certain exceptions for the Liberty Zone area in New York and the Gulf Zone area of the Hurricane Katrina. And there was also some exceptions in place for Midwestern disaster areas during those years. But by and large, most people had no opportunity for bonus in 5, 6, or 7. But for property placed in service after 2007, 50% bonus depreciation is in play. And the rules, as I said, seem pretty similar to the ones we've just discussed. And if you qualify under the 100% rules, you go with the 100% rules. But if you don't qualify under the 100% rules, then you see if you qualify under the 50% rules, in essence. So under the 50% rules, it has to be tangible property with a recovery period of 20 years or less. It has to be or water utility property or computer software or leasehold improvement property. So none of that seems very different to me. You must have acquired the property after December 31, 2007 with no written binding contract for the acquisition in effect before that date. The property must be placed in service for use in your trade or business or for the production of income before January 1, 2013. So the 100% bonus expires at the end of 2011, but 50% bonus will expire at the end of 2012 unless we see it extended. And the original use of the property must begin with you on or after December 31, 2007, and it cannot be, again, a form of accepted property. So there were some questions earlier about what is qualified leasehold improvement property, and I told you we would get into that. Here are the gritty details. The rules about when you can claim bonus depreciation on leasehold improvement property, and when, in fact, those leasehold improvements can be depreciated over 15 years rather than 39 years. So qualified leasehold improvement property includes improvements to the interior part of a building that is non-residential real property if all of the following requirements are met. Number 1, the improvement is made by a lessee or the tenant. The part of the building being improved is to be occupied exclusively by the lessee or a sublessee. The improvement is placed in service more than 3 years after the date the building was first placed in service by any person. So if you've got a brand new commercial building, freshly built, you can't claim 15-year life on leasehold improvements. The building has to be in service for 3 or more years, and then you start making improvements and it qualifies. And of course, the improvement is Section 1250 property. Section 1250 property is property that is a part of real estate or attached to real estate, that is the land, a structure on the land. What is non-qualified property? Qualified leasehold improvement property is not any of the following: the enlargement of the building, an elevator or escalator, any structural component benefiting a common area, the internal structural framework of the building, property leased to a related person. And then it goes on to a very long list of who is related. I am not going to read this to you because you would go numb listening to me. But what it essentially says is if you are the owner of a corporation and you are the owner of a rental property, then that would be related. And you can't therefore say that as the owner of your business, the business is going to rent from the rental property you own and you're going to be able to be a tenant in your own building. You're not going to be able to bypass the rules. They also go on to say 2 corporations that are members of the same controlled group, 2 people who are related by blood, such as 2 brothers renting to each other. Those are examples of related. And if you are leasing property from someone who is related to you, you do not get to use the 15-year life. You're going to have to go 39 years, and if you can't go 15 years, you can't claim bonus, you can't claim Section 179, you can't claim 150% declining balance. There's all kinds of things you can't do if you have a leasehold improvement and you are basically treated as the owner of that property. Making the election not to use bonus. Well, bonus sounds like a pretty good deal if I want it, but you know, one of the purposes of bonus has been to spur investment in new equipment and stimulate the economy through all of these investments in equipment. And in exchange for these investments, these businesses are going to get big write-offs, and that's all fine and dandy if the business is actually making a profit. And as we've seen since 2008, lots of businesses are losing money. And what is the point of big write-offs when you're losing money? So quite frankly, bonus depreciation, although it is something that I sometimes use, it is also something that I often tell my clients not to take. Because I'm looking at their business and I'm saying, hey, you know, if we claim all this bonus depreciation this year, you're going to have nothing for next year, and next year's looking a lot rosier than this year. I recommend we elect out of bonus. So is it possible to elect out of bonus? Yes, it is. How do you go about doing it? Well, let's learn about that now. You can elect out of the special depreciation allowance if you don't want to take it with respect to any class of property. The election not to claim the special depreciation allowance applies to all assets in a class of property placed in service during the same year. So if you elect out of bonus for one asset in a class, you must elect out of bonus for all assets in that same class. To make an election, attach a statement to your timely filed return, including extensions indicating the class or classes of property for which you are making the election, and that for each of these classes you are not claiming any special depreciation allowance. The election must be separately made by each person owning qualified property, for example, by the partnership, by the S corporation, or by a common parent of a consolidated group. If you timely filed your return without making the election, you can still make the election by filing an amended return within 6 months of the due date of the return, including extensions. Write filed pursuant to Section 301.9100-2 on the amended return. Once you make the election to not claim bonus, you cannot revoke it without IRS consent. So the bottom line in all of this is bonus is automatic. Your computer software is automatically going to give you bonus, and if you don't want bonus, you have to go in there and make an election to not claim it. And guess what? If you've got a client who's filing their tax return late, they can't elect out of bonus because they're not filing a timely filed return. Therefore, bonus will be mandatory for someone who is filing their return late. So my client comes in with 3 years of tax returns. He wants me to prepare them all at one time. That means every year we're filing late, bonus is mandatory. It's not even a discussion I need to have with him. And for many tax preparers using computer software, the computer software will default to bonus. So there's not many questions you need to ask when the year's out. If you get a new client who comes in with their prior year return and you see that there was depreciation claimed on that prior year return, but you don't have a copy of the depreciation schedule, it is possible to apply bonus calculations and the other methods I've already given you in class to figure out how much depreciation was already claimed on each asset, as long as you remember what the bonus amount was for that particular year. Now, if you elect out of the 100% special depreciation allowance for property acquired after September 8, 2010 and placed in service before January 1, 2012, the property does not qualify for 50% bonus. So it isn't like you elect out of 100% and get 50 instead. You elect out of 100% and you get no bonus at all. Under the old systems that were in place during Bush's administration, 30% bonus came in first and was followed by 50, and at that time you could elect out of 50 and take 30 instead. But they're specifically saying that under this system, bonus is automatic. If you don't want bonus at 100%, you can't take 50 instead. And so if you don't want 100%, you just go to makers or straight line, whatever your choice is. And if you are falling under the 50% rule and you don't want the 50% rule, then you elect out and you are again at makers double declining balance, 150 declining balance, or straight line, whatever your preference is. There's a question here. Whitney Gonzalez says, can you change the bonus election the following year? Well, the bonus election is made in the year you place an asset in service. Once you have not elected out of bonus, you can't elect out of it later. except within 6 months on a timely filed return, you have an ability to amend and go back. But once the year is over, 6 months have passed from the original deadline of that return, you're locked into bonus. There's no recovering from it. But of course, each and every year we look at bonus, we're looking only at bonus for assets placed in service in that year. So bonus is only ever claimed in the year you acquire an asset and place it in service in your business. It's not something you make a decision about 3 years down the road. And I do see another question here from Kim West. Does that work in reverse? Can you elect to claim one item of bonus depreciation and not take them all? The answer is you make a decision to claim bonus on a class-by-class basis. So I could elect to claim bonus on 15-year property. Well, actually, you don't elect to claim bonus. You are automatically claiming bonus unless you elect out of bonus. So I could elect out of bonus on 5- and 7-year property, but not elect out of bonus on 15-year property. I could do that. And I said that I would show you in my computer how things work on our software, including how I tell my software to not claim bonus. I can show you that in a little bit, maybe after lunch. I want to kind of finish all the basics here, and after we're working through some depreciation calculations manually, filling out forms manually, I think that would be a good time to show you how computers think, how we can talk to a computer. So figuring the special depreciation deduction. To determine the amount of your special depreciation deduction, multiply the cost of the qualifying property by 30, 50, or 100% as appropriate for the year and date placed in service. Figure the allowance after you figure the Section 179 deduction, but before you figure regular depreciation. And here's an example of 50% bonus. On September 3, 2010, and it has to be 2010, folks, because in 2011 it's 100% bonus, right? So I had to keep this an old illustration. You bought a computer network for your business that cost $50,000. You did not elect to claim a Section 179 deduction. Calculate your special 50% depreciation allowance as follows. Multiply the cost of the network by 50%. 50,000 times 50% is 25,000. Your special depreciation allowance is $25,000. The remaining $25,000 cost of that network is going to be depreciated using 5-year makers. Example number 2, 50% bonus depreciation combined with the Section 179 deduction. Assume the same facts as above, the $50,000 network is purchased, but you then claim a $20,000 Section 179 deduction. You then figure your 50% bonus as follows. Reduce the depreciable basis in the network to $30,000. So 50 minus 30 is 20. 50 minus 20 is 30. April's math again. And multiply the adjusted basis by 50%. So 30 times 50 is $15,000. That means your bonus depreciation will be 15 in 2010, and the remaining $15,000 cost of the network will be depreciated using 5-year makers. So how do you claim bonus? Well, you figure your bonus depreciation deduction, and then you enter it on line 14 in Part 2 of Form 4562. So again, what page is that on in my, I have a stubborn refusal to remember page numbers. I think it was right around, 53, I got it. Okay, so page 53 of our manual, we've got Form 4562, page 1. And Part 2, line 14, is where we're claiming that bonus depreciation deduction. And any part that's not claimed as bonus depreciation would move down and be entered in line 19B. So on that computer network where we claimed a Section 179 deduction, we'd describe the property. We'd take $20,000 as elected cost, leaving us with $30,000 of depreciable basis. We would then multiply that by 15% because we're working on a 2010 return in our illustration. And we'd enter $15,000 on line 14. And that would leave us $15,000 to enter on line 19B in column C. And the recovery period would be 5 years. So I'd go 15 divided by 5. And then I'd apply the half-year convention. So I'd divide it by 2 again. And then it's double declining balance, so I would multiply it by 2 and enter my total in column G. Got it? Where were we? Thank you, 25. I can always remember the year I was born. It never changes. But how old I am, I have to figure that out. All right, here's an illustration. Oh, maybe I'm going to give you an illustration. Yeah, Tiffany Banner purchased and placed in service the following property for service in her business, this time in 2011. I wanted to give you something current for the current year. We have office furniture with a cost of $10,000 and a computer-based telephone system costing $20,000. And she is going to elect out of bonus on the computer-based telephone system, but she's going to claim bonus on the office furniture. So ultimately what happens is she has total cost of property placed in service during the year is $30,000. She's going to take 100% bonus on the 7-year property and enter $10,000 on line 14 right here. She can't claim bonus on part of the computer-based system or any of the other assets that are in the same class as the computer-based system, but she can elect completely out of bonus for the whole system and all other assets in that same class. So she's going to do that, and that's 5-year property. And so ultimately, $20,000 times 20% is going to give us first-year depreciation on that property of $4,000. And then she would fill out her Form 4562, Parts 2 and 3 as follows. Looks like somehow my bars that are supposed to be over stuff got moved. So I'll have to correct those. It makes it a little bit hard for you to follow me. But here up on line 14, this yellow bar should be around line 14, highlighting $10,000 of bonus on the furniture. And then the bar should be around column B or line B, showing $20,000, 5-year property, half-year convention, 200% declining balance, and a $4,000 deduction. So we're moving into a discussion of the Section 179 deduction, and frankly, for whenever we have bonus in play, especially 100% bonus, it's pretty easy to just let your computer grab bonus instead of taking a Section 179 deduction. However, the deal is that a lot of states are not recognizing bonus or not allowing bonus. For example, California does not recognize bonus depreciation. It does not allow it. But California does allow a Section 179 deduction. So if you're thinking at the state level, as well as at the federal level for a small business, it would make sense to elect out of bonus and grab a Section 179 deduction instead if you want to save on both the state return and the federal return if you're in California. Our home state here in Oregon is gloriously complicated in that in the early days of bonus, they allowed bonus. And then they did not allow bonus for 2009 and 10, but they are allowing it again in 11. So this is a state where it just can't seem to make up its mind, and year by year we may or may not be allowed to claim bonus in Oregon. And for those of you who are neither in Oregon or California, it's going to be up to you to figure out what your state allows. But it is something that you need to be considering. What are the state rules regarding bonus, and do they allow them? And also at the state level, does your state allow Section 179? Because this course, as I'm teaching it, is showing you how to fill out Form 4562 and keep a depreciation schedule at the federal level. But you will notice that most tax software also runs state depreciation schedules, and that's because at the state level, many states calculate depreciation under different rules. And at the state level, you want to be paying attention to what your software is doing or not doing to make sure the state return is coming out correctly. For example, here in the state of Oregon, for years that bonus is not allowed, if your software allows bonus on the return, is there a possibility Oregon's going to figure it out and disallow it? Maybe. Certainly at the federal level, at the California level, would the state of California figure it out? Absolutely, because California actually has you attach a depreciation schedule like 4562 directly to the form. So if you've done the California schedule wrong, they're going to pick it up. You might be in a state where it's only ever going to get caught in an audit, but either way you want to be paying attention to the state rules and seeing how they differ from the federal rules. But today we're going to talk about Section 179 deduction as it applies at the federal level. And generally, you must claim the cost of an asset placed in service through depreciation. In years where we don't have bonus, the only way we recover the cost of property is through depreciation or amortization. And you're just not simply allowed to claim that depreciable asset as an expense on your tax return, except as provided for under the Section 179 expense election. And even when you make an election under Section 179, the deduction is still being carried through Form 4562. It's not like you're all of a sudden entering expense directly on the Schedule E or the Schedule C or the 1120S. That's not how it's being done. You're always completing the 4562 and telling the government, I am making this election to claim a Section 179 deduction. So it can never be accidental. It's always a very deliberate thing. Now, if you acquire and place an asset in service during the year in your active trader business, you can make the election to expense an asset rather than to depreciate it. Only certain property is allowed to be expensed, so we're going to cover what that is. As a general rule, you can expense tangible personal property only. However, certain other property can also be expensed. The following depreciable property is qualifying Section 179 property: tangible personal property, other tangible property except buildings and their components used for production, manufacturing, furnishing, transportation, communication, or utilities, a single-purpose agricultural or horticultural structure, petroleum storage facilities, off-the-shelf computer software, and qualified real property. Qualified real property would be property that qualifies as leasehold improvement property for the 15-year depreciation. That would be it. That's what we mean by qualified real property. Tangible personal property is any tangible property that is not real property, and it includes the following: machinery and equipment, property contained in or attached to a building other than its constructional components, such as refrigerators, grocery store counters, office equipment, printing presses, testing equipment, and signs. So even in the days before bonus, you might think of a grocery store counter as a leasehold improvement because it's affixed to the building. But the IRS says no, a grocery store counter and the cases and so forth that might get installed in a building, even the light fixtures that you would install in a building as a tenant, those are personal property and you can still claim a Section 179 deduction on them. Also, gasoline storage tanks and pumps at retail service stations, livestock including horses, cattle, hogs, sheep, goats, and mink and other fur-bearing animals. My son has pet chinchillas, but we won't talk about those. We're not going to turn them into little furry things to make a coat out of. Qualified real property. You can elect to treat certain qualified real property you place in service as Section 179 property for tax years beginning in 2010. If this election is made, the term Section 179 property will include any of the following qualified real property. That is qualified leasehold improvement property, qualified restaurant property, or qualified retail improvement property. Now every year when I update this manual, I'm always concerned, did it really start in 2010 or was it some other year? So I actually went through all issues of publication 946 from 2004 forward, and it really is the case that beginning in 2010 only a Section 179 deduction is allowed on these types of improvements. So for 2010, 2011, the Section 179 deduction is allowed, but in earlier years, bonus was allowed, but not Section 179. Got that straight? Okay, when can I claim a Section 179 expense? Well, to claim the expense, all of the following must be true. Firstly, the property must be used more than 50% in a trader business. The property must be acquired for use in your trader business. The property must be purchased and cannot be acquired from a related person or group. You must elect to claim a Section 179 expense in the first year the property is placed in service. So this brings to point, if you are starting up a new business for the first time, you might look around your home for things you already own that you could start to use in your business. And on the date that you convert personal property to business use property, you're going to start claiming depreciation. So let's just suppose I decided to start up a tax business, and I had my home computer, I had an extra laptop, I had some furniture, I had some pieces of artwork, and it took all of that personal property that I own, and I went over and signed a lease on a small little storefront and put my furniture in there, and then I also went out and bought some extra stuff. So we're going to look at depreciation beginning on the date that I placed my personal property in service, and my depreciable basis is going to be the lesser of the cost or the fair market value on the date I make that conversion. But I will not be allowed to claim a Section 179 deduction for any of my personal property that I converted to business use. Now I can claim a Section 179 deduction on any other property I go out to buy. So if you've been in computer software, one of the questions our Drake software asks is there's little boxes, was this property used? It doesn't mean did you buy used property, it means did you convert your own personal property that's already been used by you for other purposes into business use. And if you say check used property on it, the software will not allow Section 179 to happen, and it'll probably disallow a few other things as well. So essentially, in the year you first purchase property and place it in service in your business, that is the one opportunity in time you have to claim a Section 179 deduction. And if you don't do it there, you can't decide to do a Section 179 deduction the next year. It used to be the case that you had to make a Section 179 deduction on a timely filed return. So if you filed late, you couldn't go back and take it. Or if you filed without it, you couldn't go back, amend, and take it. But those rules are old. They are gone. And in modern times, if you fail to make a Section 179 election on a timely filed return, you are able to go back and amend and put it in there. It is possible to do that now. There's a question in the classroom. This is actually a sale of asset question, but there's a question in the classroom about, well, when you talk about selling it, that's a sale question. And when you're figuring the basis for depreciation, that's a basis of asset question. But when you're looking at setting up an asset to begin depreciation on it, and that asset has previously been held for personal purposes, and you make that conversion, the rules say you're going to use the lesser of the fair market value or your adjusted cost in that property. And your adjusted cost is what you paid for it plus or minus any improvements. Well, actually, it's plus improvements minus disaster losses and so forth. You finally arrive at a number that is your adjusted basis. Is your adjusted basis more than the fair market value? If it is, you go with the fair market value. And you begin depreciating based on that fair market value. Now, if the day comes where you sell that house, are you going to be allowed to realize are you going to be forced to realize a larger profit if it went up in value again? And I would say you would use the same rules as gift rules, which means it would depend on where you sell it. If you sell it somewhere between the fair market value and what you paid for it, then it would be no gain or loss. And if you sold it for less, then you would go with the lesser fair market. And if you sold it for gain, you'd go with the higher. That's where I think that would be. For all of the life I've been doing taxes, it's never been an issue to worry about real estate because it's always gone up, 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 right? It's only in our current economy that we even have to start questioning these things about, has a property been converted to business use that now has less of a value than the cost in it? All right, so property acquired for business use. To qualify for the Section 179 deduction, your property must have been acquired for use in your trade or business. Property you acquire only for the production of income such as investment property, rental property, that is if rental property or renting property is not your trade or business directly, and property that produces royalties do not qualify for the Section 179 deduction. Partial business use. When you use property for both business and non-business purposes, you can elect the Section 179 deduction only if you use the property more than 50% for business use. You multiply your original cost in that property or the cost that's being considered cost for depreciation by the percentage of business use to determine how much you're going to be allowed to claim depreciation on. And here is an example. Mary Oak bought and placed in service an item of Section 179 property costing $11,000. She used the property 80% for her business and 20% for personal purposes. The business part of the cost of the property is $8,800. That's 80% of $11,000. If Mary elects to expense the item, her maximum Section 179 deduction for the item will be $8,800. To qualify for the Section 179 deduction, your property must have been acquired by purchase. For example, property acquired by gift or inheritance does not qualify. Property is not considered acquired by purchase in the following situations. It is acquired by one member of a controlled group from another member of the same group. That is a corporation owning another corporation, for example, and selling to each other. That would not be by purchase. Its base is determined either in whole or in part by its adjusted basis in the hands of the person from whom it was acquired, such as an individual converting their personal property to business use, or under the stepped-up basis rules for property acquired from a decedent, or it is acquired from a related person. Property which cannot be expensed. Even if other requirements for expensing are met, you cannot elect the Section 179 deduction for the following property. Certain property you lease to others if you are a non-corporate lessor. Certain property used predominantly to furnish lodging or in connection with the furnishing of lodging. I learned really the hard way on this one, folks. You know, sometimes it takes a real practical example to make a law come home, but I learned the hard way on this. I had a client that was a construction worker, and he purchased himself a travel trailer to live in while he was working on construction projects away from home. And I thought, oh, well, that's nice. It's 100% business use. He said he never used it for anything personal. He was not a camper. It was literally purchased for one purpose only, and that was to provide lodging for himself, which is the problem. While he was working on construction sites. So needless to say, IRS said no Section 179 deduction was allowed on that travel trailer. Air conditioning or heating units. Property used predominantly outside of the United States, except property described in Section 168 of the Internal Revenue Code, and property used by certain tax-exempt organizations, except property used in connection with the production of income, subject to the tax on unrelated trade or business income. That'll mean something to you if you're working on nonprofit returns. Property used by governmental units or foreign persons or entities, except property used under a lease with a term of less than 6 months. Land and land improvements are never eligible for Section 179 deduction, including swimming pools, paved parking lots, wharves, docks, bridges, and fences. You cannot claim a Section 179 deduction on them. Property used for lodging, again, no Section 179 deduction. We're also going to look at some special rules that apply to leased property. Generally, you cannot claim a Section 179 deduction based on the cost of property you lease to somebody else. The rule does not apply to corporations. However, you can claim a Section 179 deduction for the cost of the following property. Property you manufacture or produce and then lease to others. Property you purchase and lease to others if both of the following tests are met. First test is that the term of the lease, including options to renew, is less than 50% of the property's class life. So this is just a business that's renting out tools for a short period of time, for example, or a car for a short period of time, not like a long-term rental thing. And the first 12 months after the property is transferred to the lessee, the total business deductions you are allowed on the property, other than rents and reimbursed amounts, are more than 15% of the rental income on the property. So if you end up with someone who has questions about rental, leased property, or leasing property and claiming a Section 179, you'd have to look at these rules and apply them to see if they're going to be able to claim that deduction or not. Property, No, there's a question in the classroom, motels and hotels, do they qualify or not? That's actually the very next thing that we're onto, so let's go through these rules. Generally, you cannot claim a Section 179 deduction for property used for predominantly to furnish lodging or in connection with the furnishing of lodging. However, this rule does not apply to the following types of property. Non-lodging commercial facilities that are available to those not using the lodging facilities on the same basis as they are available to those using the lodging facilities. That one's never made much sense to me, but the next one makes more sense. Property used by a hotel or motel in connection with the trade or business of furnishing lodging, where the predominant portion of the accommodation is used by transients. So essentially, if you purchase lodging for use in your business, but it's not lodging used in your business for transients, you're not renting the lodging or providing hotel rooms, for example, you're not going to be able to claim a Section 179 deduction on that property. But if you are a motel or a hotel in the business of providing lodging to transient people, yes, you are allowed a Section 179 deduction. Any historic structure to the extent its basis is due to qualified rehabilitation expenditures. So normally, lodging would not qualify for a Section 179 deduction, but if it's a certified historic structure and the expense you've incurred is for qualified rehabilitation expenditures, those can qualify. Also, any energy property as a part of lodging is qualified for the Section 179 deduction, and it goes on to define what energy property is. So you think about most of the things that you would do to property, like leasehold improvements, for example, when we're not dealing with the current rules that allow leasehold improvements to be treated as if they are 15-year property, and rather they have to be 39-year property. When we're dealing with those rules and we're allowed bonus, we're also allowed Section 179. But let's just throw those out, say those rules for bonus have expired. We no longer have 15-year life, and now we're looking at improvements we're making to commercial property. And do those improvements qualify for Section 179 deduction or not? The answer is if they are energy improvements, they do. So, for example, if you install equipment that uses solar energy to generate electricity to heat or cool a structure, or to provide hot water for use in a structure, or to provide solar process heat except for equipment used to generate heat to a swimming pool, that would qualify for the Section 179 deduction. even though it might be considered a structural component of the property that's been installed. Also, equipment placed in service after December 31, 2005 and before January 1, 2017 that uses solar energy to illuminate the inside of a structure using fiber optic distributed sunlight. That sounds really cool. I think I want to get me that one. Equipment used to purchase or produce, distribute, or use energy derived from a geothermal deposit. For electricity generated by geothermal power, this includes equipment up to but not including the electrical transmission stage, and qualified fuel cell property or qualified microturbine property placed in service after December 31, 2005 and before January 1, 2017. Also, relating to this energy property, you can claim the construction, reconstruction, or erection of the property. The property you acquire must be original, and the use must first begin with you. It can't be used property. And finally, the property must meet the tax performance or meet the performance and quality standards, if any, prescribed by income tax regulations in effect at the time you get the property. So this little table here provides a good little summary of what you can and cannot expense, because in general, we're not dealing with too many geothermal deposits with our clients or microturbine issues. We're just dealing with the basics for the most part. So what can be expensed? Grocery store counters, refrigerators, transportation equipment, office equipment, printing presses, signs, livestock, single-purpose agricultural structures, single-purpose horticultural structures, petroleum storage facilities except buildings, and certain leasehold restaurant improvements for 2010 and 11 at this point. And what cannot be expensed includes swimming pools, paved parking areas, bridges, fences, docks, buildings, heating and air conditioning units, permanent structures, property used for lodging, property you lease from others, and most of the type of property you might lease to others. How do I claim a Section 179 election? Well, you do it by completing Part 1 of Form 4562. And if you placed, however, listed property in service in the year, and you want to claim a Section 179 deduction on listed property, you would claim the Section 179 deduction in Part 5 of Form 4562 rather than in Part 1. And this is a picture here of Part 5. Section 179 deduction limits. For most property, the maximum total Section 179 deduction you can claim in 2011 is $500,000. Now, I think I can remember when that limit was $15,000, or was it even $10,000? When we go back 20 years, when I first got in this business, the deduction was tiny, and it really leapt up under Bush. When he brought in bonus depreciation, they also greatly inflated the amount of Section 179 deduction. Those limits just right up. But I can remember not so long ago, well, 20 years is a long time, I know, when the limits were dramatically less. And some reason I have $15,000, $18,000 in my head as a number that was around for quite a while. That was the upper limit. That was the most Section 179 deduction you could claim. So $500,000 is huge, and it's actually only temporary. After the extension of tax cuts expires at the end of 2012, these are supposed to drop down again. Can't tell you to exactly what, but they are supposed to drop down. Now, most people, the limit is $500,000. However, the maximum deduction allowed for sport utility vehicles is only $25,000 per vehicle. The maximum deduction allowed for qualified real property is limited to $250,000. For qualified enterprise zone property, the maximum deduction is increased by $35,000 to $535,000. And for qualified disaster assistance property, the maximum deduction is increased by $100,000 to $600,000. No Section 179 deduction allowed. You may not be allowed to claim the full $500,000 if the total cost of all qualifying Section 179 property placed in service during the year is more than $2 million, or the cost of qualified property placed in service during the year is greater than your taxable income from the active conduct of a trade or business, prior to figuring the 179 deduction, self-employed tax deduction, or the NOL deduction. And I have a little asterisk here which says income from an active conduct of a trade or business also includes income from wages. So if you are a self-employed individual and you are filing a Form 1040 and you have a small business that you're reporting on there as Schedule C, but you also have a job or your spouse has a job that's being reported on line 7 of the 1040 as wages, that income from that job can be offset by a loss on the Schedule C through the Section 179 deduction. But that really is only allowed on the individual return at the individual level. If you move over to an S corporation return or a partnership return, you can't claim a deduction that turns the business into a loss. Here is an illustration of how the Section 179 limit works. In this illustration, we have a character named Ann Gable who purchased and placed in service $2.2 million of qualified Section 179 property. Her business profit for the year is $300,000. Her Section 179 deduction will be limited to $300,000 as calculated as follows. It's actually limited to $300,000 for two reasons. Firstly, it can't be more than her income, right? But the other side of it is we have to reduce the cost of property that she's allowed to claim a deduction for by the amount by which the cost of that property exceeds $2 million. So if she places $2.2 million worth of property in service during the year, 2.2 exceeds 2 by $200,000. So the maximum Section 179 deduction she's allowed to claim is $500,000, but that's reduced by the difference between these two numbers by $200,000. And that leaves us $300,000, which is the most her deduction could be. So the fact that her business had a profit of $300,000 is just kind of coincidental. She's being limited to the exact same $300,000 in two respects. So how do we claim the deduction? We enter a description, manufacturing line, the cost of the business property, the elected cost is $300,000, and $300,000 is the ultimate amount she's allowed to claim the deduction for. Now the rest of it, under 2011 laws, could be bonus depreciated out, unless she elects out of bonus, and she could do that. So the next one is line, married persons must share the limit. For purposes of calculating the maximum deduction and maximum dollar limits, a married couple is treated as one taxpayer. It does not matter if they file married filing joint or married filing separate. They must share the same allowable limits. What that is saying is that a married couple, if they file a joint return together, the limit is $500,000. If they file separately, each of them combined can't total more than $500,000, but the IRS says it doesn't matter who claims the most. What matters is that the total can't go over $500,000, and if you're filing separately and you're fighting about it, then typically they'll just give you each half. But you can agree between you how it will work. Partnerships and partners limit. The Section 179 deduction limit applies both to the partnership and to each partner. The partnership determines its Section 179 deduction subject to the limits, and it then allocates the deduction among the partners. The same rule applies to S corporations. Generally, the rules that apply to partnerships and its partners also apply to S corporations and its shareholders. The deduction limits apply to the S corporation and to each shareholder individually. So the S corporation could turn a profit. It could decide to claim a Section 179 deduction, flow it through to the individual, and then at the individual level, the shareholder has to determine whether or not they can benefit from that deduction. Usually they can, but it's possible theoretically that they couldn't. Business income limit. The total cost you can deduct each year after you apply the dollar limit is limited to the taxable income from the active conduct of the trade or business during the year. Now, if your trade or business profit is less than the deduction that you want to claim, there is a provision that allows for a carry forward. So how that works is, let's just suppose my business profit is $200,000 and I want to claim a $400,000 Section 179 deduction. I'm going to be allowed to claim $200 of the $400, and the excess $200 will carry forward to the next year. So what do we mean by taxable income? Well, when we're trying to determine this business income limit for purposes of taxable income, there's actually a formula that the IRS does have you work through. A worksheet, in fact. I don't know if I have that in here or not. Can't remember. For purposes of determining net income from all trades or businesses, your taxable income or loss from a trade or business includes the following. Section 1231, gains or losses. A Section 1231 gain or loss is a gain or loss from the sale of a business asset, a depreciable business asset. So if you sold a computer that you'd used in your business and you sold it at a loss, that would reduce your taxable income. If you sold a commercial building that you held for use in your business and you sold it at a profit, the recovery of depreciation, actually no, that would be, yeah? thinking my way through that. There's a potential, I think, for sure, but I'm not positive, that the recovery of the depreciation on that commercial building would be a Section 1231 gain. But for sure, recovery of depreciation or recapture of depreciation on a tractor trailer or a Section 1245 property, personal property, would definitely give you a 1231 gain. Interest from working capital of your trade or business, and wages, salaries, tips, or other pay you earn as an employee all increase your taxable income. In addition, figure taxable income without regard to any of the following: the Section 179 deduction, self-employment tax deduction, any net operating loss carryback or carry forward, and any unreimbursed employee business expenses. And here I have an illustration of the business income limit creating a carry forward of the depreciation deduction under Section 179. Morgan Chevelle operates an equine transportation business, and during the year his business income totaled $200,000, and he purchased and placed in service a tractor and horse trailer costing $400,000. The tractor trailer was the only property he placed in service for the year, and he had no other business income for the year. Figure Morgan's allowable Section 179 and carry forward as shown next. And here we have, in Part 1, the maximum amount that he could be able to deduct is $500,000. It's essentially pre-printed on the form in most cases. The total cost of the Section 179 property placed in service is $400,000, and the threshold cost is $2 million. Of course, he's well below that. He's not limited on his Section 179 deduction by the cost of property placed in service. In other words, line 2 minus line 3 does not give us a positive number on line 4. Therefore, 4 is 0 and does not reduce 1. And that's why 5 and 1 are the same number. Then we move on to line 6, and its description of the tractor and trailer, the cost, the elected cost. He wants to Section 179 all of it. And so we carry that to line 8 and line 9. But then on line 11, we have to enter the business income for the year, and the business income is only $200,000. So ultimately, the amount he's able to deduct is $200,000, and the carry forward amount on line 13 is $200,000. And you will see that there is a place to enter the carryover amount the next year, and it's line 10. Line 10 is where you enter a carryover of a disallowed deduction from your earlier year's return. So line 13 on 2011 would carry to line 10 on 2012. Sale or disposition of property on which you have claimed a Section 179 deduction with a carry forward. If you sell or otherwise dispose of property before you can finish claiming a carry forward amount, you must add the unused carry forward amount back to your basis in the property. The person who buys the property doesn't get the deduction, and you don't get to claim the residual deduction in the year you sell it. You have to add it back to your basis, which is used to determine your gain or loss on the sale. Recapture of Section 179. If you sell property for which you claimed a Section 179 deduction, you may have to recapture part of your allowable deduction. You will have to recapture all of the deduction if you dispose of your property before its maker's useful life has lapsed, or the business use of the property drops to 50% or less. And you'll notice that's 50% or less, not less than 50%. So IRS is always looking at this. It has to be more than 50% business use or predominantly business use in order to be eligible for the Section 179 deduction. So if business use falls to 50%, you're going to have to do a recapture. And here is an example. You purchased a computer for $2,000 in 2010 and used it 100% in your business for that year. So you claimed a Section 179 deduction for the full $2,000 cost of the computer. Then in 2011, you decided it was time for a new computer already, and you decided to give the old computer to your children so they can play computer games on it. Since you claimed a Section 179 deduction on the old computer, you will need to recapture the excess depreciation on your 2011 return. And that recapture is figured on Form 4797, and we will cover that in our Thursday class under Sale of Assets. That's fun, folks. Can't you wait? I actually think that 4797 and 4562 are just these two compatible forms, because 4562 is the form that you use to bring a business asset into use in your business. And when the day comes that you take a business asset out of use, that goes on 4797. So they're two companion forms. One's in, one's out. Oh, we're on to listed property. I like to joke about listed property because it predates me. I used to imagine that somewhere there was this list that I had never seen. And people who've been in the business longer than me remember when these rules came out, and they kind of think I'm funny for imagining there could be a list, but I still like to know where that list is and what it looks like. But anyway, the IRS has decided that certain property is listed property, and it's listed even if it's not on a list. And essentially what listed property means is that the property could easily be used for personal purposes. And because it's easy to transfer that line from business into personal, there's a temptation for people to buy property, call it business property, when in fact it's really personal property because the personal use is so easy to make happen. And so when property can easily be used for personal as well as business at the same time, the IRS says that property is listed. And depreciation rules governing listed property are more restrictive than for other kinds of property. Listed property, see, I made my own list. It includes any passenger automobile that weighs 6,000 pounds or less, with some exceptions for specialized trucks and utility service vehicles. It also includes any other property for transportation, including airplanes, boats, motorhomes, unless it is an accepted vehicle. Property generally used for entertainment, recreation, or amusement, including photographic, phonographic, communication, and video recording equipment. Computers and related peripheral equipment, unless they are owned by a business owner and used only at a regular business establishment. But IRS does say that a home office that is used regularly and exclusively for business use is a regular business establishment. So the bottom line is, if you have a desktop computer that you purchased and it's sitting on the desk in your office, whether it's a home office or it's at a leased business site or at a commercial site, that's not listed property because it's at a regular business establishment. But a laptop computer, I personally always consider a laptop to be listed. I'm teaching this class from a laptop. Those of you who are attending my webinar can't see the laptop, but I'm sitting in front of it. And this baby goes home with me every night. And yes, I check personal emails with it, and yes, I have pictures of my children on it. That makes it listed. But if I had all of the same information on this computer and it was sitting in the office here as a desktop, then it would not be listed. So essentially, because laptops are so easily taken from an office and travel around, they're an asset that I would consider to always be listed, in my opinion. Now, okay, so we're looking at George through our window. George is one of my tax preparers, and he's working on a computer that's sitting on his desk. It has a monitor, and it has a hard drive, like the CPU unit sitting underneath. That computer is not listed property. It is here on the physical site of our commercial building. It is a place that we exclusively use for business purposes. I've never slept in this building. It is not even used for lodging. It is a commercial facility, and therefore the computer in it is not listed. However, the laptop that I carry with me and is used 95%, probably 99% for business, is listed property because it is not fixed to this establishment. It goes with me every night when I go home. Yes. There is a question, so is it the fact that you can easily use it for personal use that makes it listed? And essentially that's the answer. But the IRS has gone out of its way to say that with computers, if the computer is in a physical business location full-time, it is not listed. But if it is a computer that you carry around with you, that would make it listed because it's not permanently fixed to that office location. But it doesn't have that exception for any other form of listed property. So for example, a car is always listed property, right? And phonographic, communication, and video recording equipment is always listed property. That's what it's saying. Certain property has been eliminated from the definition of listed property. For tax years beginning after 2009, cellular telephones and similar telecommunications equipment have been removed from the definition of listed property. And there was a big sigh of relief when that happened. And, you know, frankly, the IRS I was observing in audits was already slacking up on cell phones long before this rule passed. But let's just think about it. How many people are given a cell phone by their employer for use in their business? And employers were being expected to monitor employee use of these phones and only claim deductions when the employee was not using the phone for business, or worse, to gross the employee's pay up by any personal use of the phone and track that for payroll reporting purposes. So that was the one side of it. The other side of it is you're just self-employed and you've bought a cell phone for use in your business. Keeping the records to prove how much was business and how much was personal. That's part of what listed property is about, is tracking and monitoring all of the use of that property and be able to document how much was personal and how much was business. For example, there's the mileage log, but technically speaking, you should be able to show the use log for a cell phone if that cell phone is listed property. So IRS is now saying cell phones are off the list. They are no longer listed. So how does it work in an audit when a client and I go to an audit and the auditor says, how much business use was your cell phone? How does that work now? My client says 75% business use and the auditor says, okay. If my client says 100% business use, the auditor goes, really? No one's cell phone is 100% business use, so that's impossible. But 75% business use, 80%, even 90%, I have not seen them bat an eye. 50, they won't, that's fine. The main thing about 50% business use on a cell phone is if you want to claim a Section 179 deduction for the cost of that cell phone, you can't, because it has to be more than 50% business use to qualify. An employer-issued phone is 100% business use, period. Well, clearly, any employee can take a cell phone and use it for personal purposes. The question is the employer going to be required to track that personal use and gross the employee's payroll up by the value of it? And the answer is at this point, no. That's done. But the rule still is in play for cars. So cars are the bigger example. If you work for a company that has given you a company car, you are supposed to track the use of that car and report it to the company. And if you don't, then the company has to take the fair market value of the use of that car into account and gross you up on your payroll, make you pay income tax and payroll tax on the car. Even in the end, if you're using a company car to go to and from work, that commute is personal use of the car. And commute use of the car is always going to be a gross up issue on payroll because the car is listed property. And then you get into airplanes. If your company has an airplane, that's listed property too. Okay, now we're on to predominant use test, because in order for property to qualify for the Section 179 deduction, it has to be predominantly used in your business. Predominant means more than half. It does not mean half. It means more than half. You cannot claim a Section 179 deduction for listed property that is used 50% or less for business, or for that matter, any property that is used 50% or less for business. It has to be more than half. Further, if you previously claimed a Section 179 deduction on listed property, and in a subsequent year your business use falls to 50% or less business use, you may have to recover part of the deduction claimed under Section 179. How to report listed property? You claim depreciation deductions for listed property in Part 5 of Form 4562. Most assets reported on Form 4562 only in the year they are placed in service. But for listed property, they have to be listed on the form every year. And the form itself says what listed property is. If you've ever stopped to actually read the form, it's interesting what you can learn. Let's look at this blow up here. Listed property includes automobiles, certain other vehicles, certain computers, and property used for entertainment, recreation, or amusement. It used to say cell phones, but they've removed that. I used to joke about the cell phone thing because, I bet you that this rule that stuck cell phones on as listed property goes back to the 70s. And back in those days, I can remember when someone had a car phone, that was like space age. Do you remember any of you ever watching The $6 Million Man? And you had Oscar, you know, the guy with OSI in the car, and he called himself Snow White, and he was on the car phone. And it was like, oh my God, that's so cool. To my 10-year-old mind, it was totally cool. So I somehow envision that it was those points in time where rich people who could afford those types of cell phones were being told to monitor their use and that they couldn't write them off if they were personal property. Because you could imagine rich people buying those types of phones and putting them in their car and not caring less about what they cost, but then trying to write it off as a business use asset. So I can see, or I hypothesize, that's probably where it all stemmed from. And then we hit a point right around the mid-1990s where everybody had a cell phone for business. And that was when it started to dawn on people that cell phones had a useful life of only a few months to a couple of years, that people were using them constantly in their business, somewhat for personal, and it was getting impossible to track. But it took until 2010 for them to get removed from listed property list. All right. Oh, now we're on to cars. Oh, speaking of listed property, let's take a look at something here on this 4562 first. You will see that listed property goes in Section A, and that Section A is divided into a few lines. Line 1 says, do you have evidence to support the business or investment use claimed? You need to answer yes, because if you can't prove you used it for business, guess what? You're not allowed to deduct it. And then the next question is the evidence written? It's supposed to be as well. Then it goes on and says, on line 25, special depreciation allowance for qualified listed properties. So if you're claiming bonus depreciation, 100% or 50%, you would enter that deduction on line 25. And then on line 26, you make a listing of every asset being depreciated or that has been depreciated and is still in business use that is listed property in the space provided. And if you run out of space, you need to attach a statement. So listed property is supposed to be listed every year. And it goes on line 26 if it's used more than 50% in your business. And it goes on line 27 if it's used 50% or less in your business. So looking at the classwork assignment I gave you before lunch, do we have any listed property there that's used? We have a laptop computer, right? And we have the car. And the laptop computer is 45% business use, so the laptop computer will get reported on line 27. And the car is 51% business use, so it will get reported on line 26.
Password number 3 is Scotia. S-C-O-T-I-A. Scotia.
All right, moving on to passenger automobiles, because passenger automobiles are not only listed property, they're subjected to additional rules as well. The amount of Section 179 deduction you can claim on passenger automobiles is limited. Quite frankly, any amount of depreciation you can ever claim on a passenger car is always limited, unless, of course, it's just a cheap junk clunker you bought for almost nothing. You know, if you went over to any kind of car dealership in the modern times and bought yourself the cheapest new car you could find, it's going to be listed property and it's probably going to get nailed with some limits. And the depreciation limits on cars have not changed over time. So the maximum upper limit that you can have for depreciation on a car does not seem to have changed in close to 20 years. But cars have gone up in cost, haven't they? They do cost more now than they did 20 years ago. I can remember when I moved to Australia in 1984, a brand new Honda Prelude was $10,000. I remember that because my dad wanted to buy one. Does anyone know what a Honda Prelude costs today? Do they still make those? They stopped with a Prelude? Oh. I haven't, come to think of it, I haven't seen one in a long time. Anyway, they got to be a lot more than that. All right. So a passenger automobile is any four-wheeled vehicle made primarily for use on public streets, roads, and highways and rated at 6,000 pounds or less. The following are not considered to be passenger automobiles, however. ambulances or hearses used directly in a trade or business, or a vehicle for hire used to transport people. Like a taxi? Maximum depreciation deduction for passenger automobiles. For 2011, the maximum total depreciation and Section 179 deduction you can claim for a passenger automobile placed in service during the year is $11,060. However, if you elect not to claim any special depreciation allowance or the vehicle is not qualified property for a bonus allowance, the maximum deduction is $3,060. Do you remember at the end of the break I said $3,060 multiplied by 51%? That's where I got that number from. It's set in stone. It's printed in 946. If your vehicle is less than 100% business use, your maximum depreciation allowance or depreciation allowed must be multiplied by this limit. $3,060 times 51% is that first line on the car. That's where I got that number. Now, the depreciation limits vary over time, but only ever slightly. You will see that for 2011, the maximum deduction you can claim in the first year you put your car in service is $11,060, but that's only if you elect bonus. If you elect out of bonus, then it's actually $3,060. That same rule was in play for 2010. For 2009, the limit is $10,960. That was a $100 difference. Woohoo. Then when we go back in time to 2007, 6, 5, we had no bonus in play in those years, so the limit was not higher. It was set at this $3,060 or $100 less than that. 2004, we had bonus, so we had a higher limit again, if you elected bonus. And then in 2003, this is when we had 30% bonus instead of 50% bonus, and that's where the $7,660 came into play. Then in the last half of 2003, we had the 50% bonus, and the number went to $10,710. And then, of course, before 2001, we had these same lower limits. So in 1997, the limit is $3,160, and if you do not elect bonus in 2012 or 2011, it's actually $100 less than it was 14 years ago. So there's been no adjustment over time for inflation in cars. The limits are what they've always been, and how they exactly adjust $100 one way or another every year, I'm not sure why. They just do. Now, in the second year, your depreciation is limited nearly always to $4,900, except in years where it's $4,800. But we go back far enough in time. At one point, it was $5,000. Why it went down again, I don't know. In the third year, it's stuck at $2,950. And in the fourth and later years, it's set at $1,775. So whether you elect bonus or not, in the second, third, and fourth years, those numbers never change. Those are the limits. It's the most you can claim. So let's see what all that means. Here is an example. In our example, no bonus depreciation is being claimed. On April 1st, 2011, you purchased and placed in service a 2011 Dodge Caravan that cost $35,000. Since the vehicle weighs less than 6,000 pounds, it is considered to be listed property and is subject to the limits on automobiles. According to your records, you used the 2011 Caravan 30% personal use and 70% business use. You elect not to take the 100% special depreciation allowance, and you calculate your depreciation as follows. So the first thing we do is we take $35,000 as the cost of the vehicle, and if we were to do 200% declining balance without regard to the fact that it's a car or listed property, we would just have a $7,000 deduction in the first year. But we have to multiply that deduction by 70% because that's the percentage business use, and we get $4,900. Except we don't get $4,900. Instead, we move over to the limits on automobiles, and the limit's only $3,060. But wait, that's if it's 100% business use, and it's only 70% business use. So 70% of $3,060 is $2,142. That's the most deduction we're allowed to claim on that car in that year. Then in year two, the depreciation deduction, if we were to just to go to the maker's tables and look at 32% of $35,000, we get $11,200. Except we don't get that number, nor do we get 70% of that number. Instead, we have to start with $4,900, multiply that by 70%, and our deduction would be limited to $3,430. Next year, we have, 19.2% under the maker's tables of $35,000. That would give us $6,720, but no, we're not allowed that number. We're not allowed 70% of that number either. Instead, we go to the limits on automobiles, and in the third year, that limit is $2,950. We multiply that by 70%, and that's the maximum deduction we can claim in the third year on that vehicle. And finally, in the fourth year of the vehicle, we would be at, 11.52%? Multiplied by the purchase price is $4,032, but we don't get that number. We don't get 70% of that number. Instead, we go to $1,775, multiply that by 70%, and the deduction is limited to $1,242 in the fourth year. And the main thing is that, of course, that would normally put you into year 5 after that, where supposedly this 5-year asset should be fully depreciated. But IRS does say if you're not able to claim full depreciation on your car because of the limits on automobiles, you are allowed to depreciate beyond the normal depreciable life of the car. So you would just keep going, frankly. Now here is another example where we are claiming bonus depreciation, and this one is a lot more complicated to figure out exactly how it works. The IRS actually does have a worksheet for figuring all of this out, and I sat there yesterday and kind of scribbled it out by hand, and ultimately this is what it's having you do. So we have the same car costing $35,000, but because we're going to elect bonus on it, our limit is not going to be $33,060, it's going to be $11,060. But we still have to multiply that by 70% use, and we get $7,742 when we do that. That's the deduction we're allowed to claim. So under 100% bonus, we should be able to claim, you would think, 70% of $35,000, but we can't. Instead, we're limited to $7,742. Are we done depreciating the vehicle? No, because we could only claim $7,742. So what do we do next? Well, if you go through and figure out that auto worksheet, it has you do a formula that ultimately gets you the same place as what I'm doing here. You start with the cost of the vehicle, multiply that out by the percentage of business use. You then look at the amount of maker's depreciation that could apply, but you can't claim it. You can't claim bonus to that extent. In the end, you only get $7,742 of bonus. But this $7,742 of bonus reduces your cost for future depreciation. So 70% of the purchase price is $24,500, and we subtract out $7,742, we get this $16,758. So that's our basis for depreciation for all future years. And when we get into year 2, it would be 32% of $16,758, wouldn't it? But if we do that, we get $53,62, and $53,62 is too big a number. We're not allowed more than $4,900, and for that matter, it's 70% of $4,900, which is $33,60. So the same base amount is our adjusted basis in the property after bonus, and each year we have to apply the limits on automobiles, and so each year our deduction is limited to the numbers you see here. And you can see that actually, based on how I rounded, these later years are all similar. All right, deductions after the recovery period has ended. If the depreciation deductions for your automobile are reduced under the passenger automobile limits, you will have unrecovered basis in your automobile at the end of the recovery period. If you continue to use the automobile for business, you can deduct that unrecovered basis after the recovery period ends, which is what I already explained. But note, you cannot claim a depreciation deduction for listed property other than passenger automobiles after the recovery period ends. So yes, the question is, Whitney is asking, do you keep depreciating the vehicle even after the recovery period ends? And the answer is yes, you do. You keep going until it's used up because it's listed property. Would Hertz and Avis Hertz and Avis would be using property that is leased short-term, so it should be eligible for the deduction. However, you would be looking at individual franchises, and you'd have to look at the value of property. Is it exceeding $2 million? There's all kinds of stuff going on in there. Odds are that they're going to be depreciating too much property, and they're going to be excluded from Section 179 altogether. Now, back in 2002, the IRS came up with some new limits. If you purchased a truck or a van on a truck chassis, you got to claim more than that $3,060 base amount limit. It was a big improvement, not. This is the table that applies to basically small pickup trucks and vans that are on a truck chassis that do not weigh more than 6,000 pounds. And if you have that type of vehicle, then the limit on that vehicle, instead of being $3,060, is $3,260. So if your client placed in service, trying to think of what an example is. I don't know, does a Dodge Dakota weigh more than 6,000 pounds? So I'm just trying to think of those smaller pickups. Like there's the S10 Blazer. Do they still make those? Yeah. So those smaller pickup trucks, they would weigh less than 6,000 pounds, and they're the type of vehicle that would fall onto this table. They're not a car, but they don't weigh more than 6,000 pounds, so they're going to be subjected to these limits that are all the same as the limits on passenger cars, but they're $200 higher across the board. So I've got a person here in my class who says even a full-size pickup that is not four-wheel drive is going to weigh under 6,000 pounds. Okay. I know that I went online, and this is a Chevy something here, and I went online looking for something that weighed less than 6,000 pounds, and this is one, but what I took a picture of, I don't remember. Another one I've thought about is minivans. The Dodge Caravan is on a car chassis, so it wouldn't qualify for this table, but the Chevy Astrovan, when they used to make that, that is on a truck chassis, so it would fall on this table. So I spent some time studying this stuff. I research this stuff to figure it out. All right, so we were talking about depreciation limits on cars at the end of our last portion of the class, and I can see those of you who are rejoining us are already giving me great green check marks. Thank you very much, just to let me know you are still there. And we're now on to a discussion of the rules for SUVs. Now, I'm a little bit of a green person. I've always loved the environment. Even when I was a little girl, I liked wide open spaces, and my favorite place was the mountains, and I wanted to live on a farm with my horses and just be one with nature. That's always been my ambition. So when I see the environment bad, it makes me sad, and when I see things come along that help the environment, it makes me happy. So I like green hybrid cars, and I like geothermal power, and I like wind turbines, and anything like that. It's just something personal to me. But having said that, for all the years I've been working on tax returns, one of the things that has bothered me is that the tax code says and screams, buy the biggest gas guzzling car you can, because you get good write-offs if you buy a gas guzzler, but if you buy a nice lightweight fuel efficient car, you're going to get hammered with the limits on automobiles. It's essentially what the tax code says. What the tax code says is that if you purchase a car that weighs more than 6,000 pounds, the limits on automobiles do not apply. Well, what does it take to get you to 6,000 pounds? Well, several years ago, we're talking maybe 6-7 years ago, right around December 30th, December 28th, somewhere in there, I got a phone call from a long-term client. He had won a BMW, and he was at the BMW dealership, and he was telling me that they were telling him that if he upgraded the car he won from whatever sports sedan it was that he won to their SUV, that he could write it all off. And I said, well, that would depend on how much it weighs. Well, how would I know what it weighs? And I said, well, you open up the driver's side door, and it's got two weights in there, and you add them together, and you tell me what the total is. Guess what the total was? 6,001 pounds. Now, do you think that that was accidental? So I said to him, yes, it is true. You would be able to completely write off the business portion of the use of that vehicle, because he was a real estate agent, so he was going to get a fairly dandy write-off. But at any rate, you know, manufacturers have obviously been responding to the tax code and how they design cars, and people who use cars for business are probably responding to the tax code when they make purchases, if they understand enough about the tax code to make that a part of their buying decision. So how does it work? Well, if you purchase a car that weighs 6,000 pounds or less, you're limited on the amount of depreciation you can claim, as you already see. But SUVs and vans with a gross vehicle weight rating of more than 6,000 pounds are not defined as passenger cars, and therefore those restrictions do not apply. However, they are still considered to be listed property. So a passenger car is listed property and also subject to the limits on passenger cars. Listed property is still listed, and it goes in the listed section of Form 4562 and has all the listed rules apply to it, such as you have to keep a mileage log and so forth to prove your business use. Now, in 2004, this October 22 date that we keep hovering around, the government decided to impose the first restriction on those gas-guzzling SUVs. And that restriction was that the Section 179 deduction for any single SUV purchased and placed in service during the year could never exceed $25,000. Well, I thought, well, that's hardly an incentive to worry about. But what it would affect is, let's just say you went out and bought one of those Cadillac SUVs that cost $60,000. The maximum Section 179 deduction you would be able to claim on it is $25,000, assuming it was 100% business use, right? Actually, it doesn't even matter. It's just $25,000. I don't think the business use falls into it as long as it's more than 50% business use. I haven't seen this limit being multiplied by the business use percentage. So it's just $25,000 is the most you can claim on that vehicle during the year. Now, of course, my mind immediately started going, what's an SUV? What isn't an SUV? And so they defined that in the code, and the way they defined it was not actually that easy to understand. And when I first started reading it, I laughed. And then someone explained to me that this one is a pickup truck. So I started thinking about the others and analyzing what they meant, and here's what they mean. So this $25,000 limit on the Section 179 deduction applies only to SUVs. And an SUV is defined as a four-wheel drive vehicle primarily designed or used to carry passengers over public streets, roads, or highways, and is not subject to the passenger automobile limits, and is rated at no more than 14,000 pounds gross vehicle weight. But the $25,000 limit does not apply to any vehicle designed to have a seating capacity of 9 or more persons behind the driver's seat. So I thought, what would that be? And I imagined those vans that, you know, sometimes we get picked up from the airport in that go to the hotels. Because you got the front seat, and then can you fit 9 in back? Because if you can fit 9 or more in back, then they wouldn't fall under those SUV rules. And this would be a picture of one of those. It's a 12-passenger van, by the way. Then the next one is the one that someone else had to point out to me because I wasn't smart enough to figure it out, but it does make sense now. The vehicle is equipped with a cargo area of at least 6 feet in interior length that is an open area or is designed for use as an open area, but is enclosed by a cap and is not readily accessible directly from the passenger compartment. Well, that did have to be explained to me, folks. That is a pickup truck. All right? And then also has an integral enclosure fully enclosing the driver compartment and any load-carrying device, does not have seating rearward of the driver's seat, and has no body section protruding more than 30 inches ahead of the leading edge of the windshield. Well, I figured out this is what it means, this baby right here. So like those UPS delivery trucks. Or what's another one? The Sprint, the Freightliner Sprints, the Sprinter vans, yeah, those. So how to claim depreciation on vehicles? Well, whether your vehicle is a passenger automobile, an SUV, or a vehicle that is not subject to the limits on SUVs, it's always still going to be listed property. And listed property needs to go in Part 5. And if it's more than 50% business use, you list it on line 26. And if it's 50% or less business use, you put it on line 27. Now, in addition to that information being provided, you also have to provide information about the use of the vehicles. And get this in Section B, information on use of vehicles. Complete this section for vehicles used by a sole proprietor, partner, or other more than 5% owner or related person. If you provided vehicles to your employees, first answer the questions in Section C to see if you meet an exception to completing this section. So essentially, my interpretation of this is that if the business is claiming automobile expenses for a vehicle used by an owner of the business, then the owner has to provide this information about their business use. If the business owns its own vehicles and provides vehicles for use by the employees, then you have to fill out this section for employee use. All right, so they're basically tracking that employee use of vehicles and owner use of vehicles.
It is now time to complete classwork assignment number 1. We're going to take a break from this very lengthy lecture on depreciation. And actually, we're dividing the depreciation topic into 2 separate sessions. So both 15 and 16 of the basic tax course are going to be devoted to the topic of depreciation. In prior years, we tried to squeeze depreciation into a single session just because of the weighted importance it was given on state and federal exams. However, we've universally had complaints from our students that they just don't get depreciation after cramming it all into one session. So we decided decided this year that even though the weighted importance of this particular topic on examinations is probably low, that we as a school place high importance on it, and any employer who ever hires you is going to place high importance on it. So for practical purposes, this is a crucially important session, and that's why we decided to not cram it all into one session, but rather spread it out over two. And so we're going to be taking the assignments that are incorporated into this manual and also dividing those up between the two sessions. So for today, for classwork, we are going to complete classwork assignments 1 and 2. And then I'm going to send you home for the day with an assignment to work on homework assignment number 1. So the other assignments, classwork assignments 3, 4, and 5, and homework assignment B, those will be completed as a part of session 16. And I have classwork assignment 1 that we're first going to cover, and your job for this particular assignment is to look at each asset described and determine whether that asset is tangible personal property, real property, or intangible property. And then accordingly, is that property depreciable, amortizable, or not depreciable at all? So at this point, please push pause on video playback and complete classwork assignment number 1 shown on page 62 of your student manual. When you are ready, please resume video playback for a review of the answer key. And I have the answer key for classwork number 1 up on the screen in front of you now. And we're going to begin with question 1A. What is an office building? Is an office building tangible, real, or intangible? The answer is, of course, it is real property. Can you depreciate an office building, or is it amortizable, or is it not depreciable at all? Well, land is not depreciable, but the building is, and so we're going to say that the office building is real property and it is depreciable. So you can see the corresponding answer key right here, real property, which is depreciable. Shares of stock, those are tangible personal property and they are not depreciable. Series E, or H bonds, those are tangible personal property and they are not depreciable or amortizable. The truck, assuming it is used in a business, is going to be tangible personal property and it would be depreciable. The rental house is real property and it also is depreciable. A vacant lot is real property, but it is not depreciable. A cow is personal property. Is it depreciable, amortizable, or not depreciable? Well, if it's used in a business, the cow is depreciable. We have a single-use agricultural or horticultural structure that is classified as tangible personal property and it is depreciable. Goodwill is intangible property and it is amortizable. Franchise fees are intangible, they are amortizable. A grocery store counter or a store counter is a personal property and it is depreciable. And startup costs are intangible and they are amortizable. So that concludes the review of the Classwork 1 answer key. Let's take a look at the Classwork 2 assignment. Classwork 2, your job is to prepare a depreciation schedule. This is going to be a little bit of work and it's a fairly lengthy assignment. Classwork number 2 says take a look at each of the assets shown on this schedule and determine the amount of depreciation that will be claimable for 2011 and to complete the depreciation schedule. Now if we flash down in the student manual, we have some depreciation schedules in here for you. And here is a depreciation schedule showing on page 70. You can print this out or you could just use a ledger piece of paper. And your job is to enter a description of each asset, the date purchased, the cost, the business use percentage, any special bonus allowance depreciation that might be claimable based on the information we're providing you, Section 179 deduction, basis for depreciation, life, method or convention, the rate of depreciation, the current depreciation being claimed, prior Section 179 expense that was claimed, total accumulated depreciation. This final column for alternative minimum tax depreciation deduction, you don't need to worry about filling that out. So here is the schedule. Here are the assets that you want to depreciate. And as you get into these assets, you'll notice that we have a car here. And the car is 51% business use, so it's important to pay attention to the business use percentage. Also, the instructions say that we do not want you to take any bonus depreciation for any of these assets, but we do want you to claim Section 179 deduction when it is allowed. And we are going to assume that this business has income of $515,000. That's not really relevant for classwork assignment number 2, but when we get into classwork assignment number 3, that will be relevant for completing Form 4562. We're not at a point where we're going to ask you to complete Form 4562 yet, but I just wanted you to reserve that piece of information up here for when you do get down to assignment number 3. And finally, assume the following information on the car. We have business of 12,000, total miles of 23,500, and commute miles of 4,000. When you take those and multiply them out, that's where we get a 51% business use on that car. And again, this particular information we've provided right here is going to be relevant to classwork assignment number 3. But for classwork assignment number 2, all we want you to do at this point is complete the depreciation schedule to the best of your ability, going through each of these assets one at a time and figuring the amount of depreciation that has been claimed and is being claimed on each asset. So at this point, please push pause on video playback and complete classwork assignment number 2. When you are ready, please resume video playback for a review of the answer key. And I now have the classwork 2 assignment answer key up on the screen in front of you. And I've designed this answer key to relatively match the table that was given to you in the problem. The first piece of information I do need to give you about the answer key is that we have kept the assets in the same order that they are appearing in the problem itself. But I did want to point out that in the problem you will see we have business activity of Schedule C, and then we have a second business activity of Schedule E. For that reason, you should actually prepare 2 separate depreciation schedules so that you're tracking your depreciation entries for each form separately. There will be a Form 4562 that needs to be completed for the Schedule C activity, and there will be a 4562 to complete for the Schedule E activity. For now, we're going to begin with the first asset in this list, which is the car. The car was kind of tricky and rather simple at the same time, depending on whether you get the limit on automobile issue. The issue being that if a car is used in a business, the amount of depreciation on that car that can be claimed in a year is limited by the limits on passenger automobiles. And the car in our assignment here is no different. And what is the limit on the amount of depreciation that can be claimed on a passenger automobile? Well, that depends on whether or not you claim bonus depreciation. In the wording of the problem, we tell you, do not take bonus depreciation. Therefore, the limit on the car is going to be that lowest limit. And for 2011, that limit is $3,060 for the whole year. But that $3,060 limit must be multiplied by the percentage of business use. This car costs $35,000. The business use percentage is 51%. That means the correct depreciation calculation for the car in its first year is going to be 51% of the limit of $3,060. So let's go over and take a look at the answer key together. So beginning with the car. The car is subject to the limits on passenger automobiles, and that means the first year in service, the depreciation deduction is limited to $3,060. We're going to take $3,060, multiply that by 51%, and we get $1,561. Now, it's likely the case that you probably didn't think of that limit and multiplied it out the long way. And just to see how you did on your calculations, we've thrown in the calculations into the answer key. So we start with the cost basis on the car of $35,000 and multiply that by 51%. That gives us a business use basis of $17,850. And there's actually nothing wrong with having done that computation because the depreciation schedule, if you complete it in full, does ask for that number. We then have the basis for depreciation on that car before any Section 179 deduction is claimed. We then look at how much depreciation we would be allowed to claim in the first year, and that's $3,570. Now, if the car was not subject to the limits, the first year depreciation that we could claim would be $3,570, but we've got 2 issues going on here. The first issue is that a Section 179 deduction is being claimed, and the second issue is that our depreciation deduction is going to be limited to just $1,561. So the $1,561 is the amount of depreciation we're claiming on the car in the first year, and we're actually going to put that deduction into the Section 179 column. The next asset in line is the office building that the cost of the office building is $250,000. It's 100% business use. It was placed in service in 2010, so 2011 is the second year of depreciation on this building, and the land value is $75,000. So how do we figure second year depreciation? We simply take the cost of the building and subtract out the land. 250 minus 75 is 175,000. We're simply going to divide that by 39 to get us our straight line depreciation deduction of $4,487. The next asset in line is the cell phone. The cell phone cost $150. It is 45% business use. So we're going to need to take that cost of $150, multiply it by 45% to get the cost basis of $68. Now, a Section 179 deduction cannot be claimed on the phone because it was not used more than 50% in a trade or business. Therefore, the best we can hope for on the phone is to claim 7-year depreciation using the double declining balance method, or the 200% declining balance method. So we're going to take first-year depreciation would be $68 divided by 7 years, and then multiply it again by 200%. You come back to $10 after all that rounding. On the laptop computer, we have similar information as we did for the cell phone. The laptop is $2,500, and it too is 45% business use. But there's a key difference between the laptop and the cell phone, and that is that the cell phone is not listed property, but the laptop is. And because the laptop is listed property that is used less than 51% in business, in other words, not used more than 50% for business, it cannot be depreciated using double declining balance under the maker's system. Instead, we're going to go over to alternative depreciation on that computer, and that computer will have to be depreciated using ADS and no double declining balance. ADS, of course, will give it straight line. The life of the computer is unchanged. It's still 5-year property. So ultimately what we do is we take $2,500, multiply that by 45% business use, and we get a basis for depreciation of $1,125. The next step is to take $1,125 and divide that by 5, but then we also have to apply the half-year convention. So $1,125 over 5 multiplied by 0.5 equals $113. First-year depreciation on that laptop computer. The next asset in line is a desktop computer that is in an office. It's 100% business use, and it would be eligible for the Section 179 deduction. So we don't even need to do any calculations on that. It's going to be a Section 179 deduction of $800. The desk is 7-year property. It is also going to be eligible for the Section 179 deduction. The depreciation that will be claimed is $450, all of which is Section 179 deduction. The next depreciation item on the list is the rental home, and you can see right here that that cost $150,000 and that the land value is $50,000. So we're going to take $150, subtract out $50 to get a depreciable basis of $100,000. The rental home was placed in service in January of 2011, so we're going to get 11 and a half months of depreciation. We're going to take $100,000, divide that by 27 and a half years, and that gives us $3,636 for a full year. But in the first year, we don't get the full year, so we're going to take $3,636, divide that by 12, and multiply that by 11 and a half months to apply the mid-month convention. That gives us first-year depreciation on the rental home of $3,485. Finally, the rental property is 5-year property. This is a rental use, and you cannot claim a Section 179 deduction on assets placed in service in a rental property. Therefore, the best we're going to be able to do is claim maker's double declining balance depreciation. So the refrigerator is going to be 5-year property, and we're going to take $500 times 20%, or 500 divided by 5. Either way, you get $100. And that will be the first year depreciation. And here is the finished depreciation schedule for the Schedule C business. You can see we've listed the car, the date placed in service, the cost is $35,000, the business use percentage is 51%, the Section 179 deduction is $1,561. The remaining basis for depreciation is going to be $16,289. So we're simply going to take $35,000, multiply that by 51%, subtract out $1,563, and that gives us $16,289. And current depreciation and the Section 179 deduction are the same number. Accumulated depreciation is $1,561. Moving on with the office building was placed in service in an earlier year. Therefore, in that earlier year, if you did some fancy footwork with your calculations, you should have been able to figure out the depreciation that should have been claimed in the first year. And to do that, you would simply take the depreciable basis of the commercial building, divide that by 39, divide that by 12, multiply that by 11.5, and you would have gotten the first year depreciation. You add that to the second year of depreciation to get the total accumulated depreciation. The cell phone cost $150, 45% business use, gives us a basis for depreciation of $68. It is 7-year property, double declining balance, that gives us $10 of depreciation. And the laptop computer, $2,500, 45% business use, a basis for depreciation of $1,125. Straight line method, half-year convention, gives us a rate of 10% and a first-year depreciation deduction of $113. The desktop computer is 100% business use. The cost is $800. The desk is also 100% business use with a cost of $450. The basis for depreciation is 0 because we're claiming a Section 179 deduction on the full cost. So current depreciation, Section 179 deduction are the same in this case. And then moving on to the rental property, we can see we have the rental home here. It has a cost of $150,000. We're pulling out the land value of $50,000, giving us a basis for depreciation of $100,000. The life on the property is 27.5 years. We're using straight line mid-month convention. That gives us a current year depreciation deduction of $3,485. On the refrigerator, we start with a cost of $500. It is 5-year property, 200% declining balance, and that gives us a current year depreciation deduction of $100. So that concludes the review of the Session 15 classwork answer key. Let's take a look at the homework assignment for Session 15. We're going to let you take it a little bit easy with the homework assignment this class. You're simply to go through, read each of the problems, and answer true or false to each question. For example, beginning with question number 1, your personal car, which you do not use for business, is it depreciable? No, it's not. False. So from this point, you go through each of the assets described and determine whether or not they are depreciable. That concludes Session 15 of the Basic Tax course. Have fun with your homework assignment. I will see you next time for Session 16. We're going to begin Session 16 with a review of the Session 15 homework answer key, proceed on with the Session 16 lecture, and then we'll have some more classwork assignments involving Form 4562 and depreciation. So thanks for your participation, and I'll see you next time. Bye-bye.